So we're calling the meeting to order of the Board of Administration for the Federated City Employees Retirement System and Federated City Employees Healthcare Trust. It's 8:33. We're going to start with a roll call, and then we're going to go immediately to closed session to about 9:30. So on the roll call, Vice Chair Chandra.
Present.
Thank you. Trustee Horowitz.
Present.
Thank you. Trustee Jennings.
Present.
Thank you. Trustee Kelleher. Not here. Trustee Orr.
Present.
Thank you. And Trustee Sun.
Yes.
Okay, thank you. And Jay Castellano, I'm here. All right, so with that, we're going to move to closed session. And again, we should resume at about 9:30. So Linda, will you take it from here? Laura's back. Quick check here. Okay, 1, 2, 3, 4. Let's see. Vice Chair Chandra, are you back now?
Yeah, I'm here.
And Trustee Sun, are you back also?
I'm here.
Okay, thank you. All right, Linda, are we good to resume?
Yes.
Okay, thank you very much. So we're going to resume open session at this point. As before, I'm going to do a quick review of ground rules for this meeting per the governor's executive order for Brown Act.
Excuse me,
Oh.
Mr. Chair.
Yes.
Is there any action out of closed session?
Oh, I'm sorry. Thank you very much for reminding me. No, there are no reportable actions out of closed session this morning. Okay, for ground rules, all votes will be roll call votes. If you're speaking, please, if you're not speaking, please be on mute to cut background noise. For discussion items, each trustee will have a turn to speak in roll call order more than once if desired. The public will have an opportunity to speak on each item after the trustees, and the public will also have an opportunity to speak again at the end of the meeting on any other item not on the agenda that is within the subject jurisdiction of the board. All right, in terms of orders of the day, if needed for the board meeting, but probably more for the governance committee meeting afterwards, there will be a recess from 1 to 1:05 to accommodate the Civic Center TV's broadcasting process. Also, let's please count on taking a short break after section 3 of the agenda regarding investments. So just before we get into the pension valuation results, we'll take a short 5-minute break. So you can please count on that. All right, and there are no items to waive on sunshine. So could I please have a motion and a second to accept orders of the day?
So moved.
Thank you,
Second.
Trustee Horowitz, and second by Trustee Vice Chair Chandra. Let's do the roll call vote. Vice Chair Chandra.
Aye.
Thank you, Trustee Horowitz.
Aye.
Thank you, Trustee Jennings.
Aye.
Thank you, Trustee Orr.
Aye.
Thank you, and Trustee Sun.
Aye.
Thank you. I also vote aye, so that motion carries unanimously. We're next going to proceed to the consent calendar. And as you can see, the consent calendar includes this meeting, approval of service retirements, approval of deferred vested, approval of board minutes, approval of return of contributions, acceptance of communication information reports, approval of travel conference attendance, rescission of retirement application. FYI, there's 1.7 rescission. It needs to be an S in there, RESC. Okay. And then approval of administrative matters. Is there any item that needs to be pulled from consent? If not, could I please have a motion and a second to approve all items on the consent calendar?
So moved.
Thank you, Trustee Horowitz, for the motion.
Yeah, and I'll second again. Vice Chair
Thank you.
Chandra.
Thank you, Vice Chair Chandra, for the second. Any discussion by the board?
I just want to say one thing.
Yes.
Just one of the people retiring is someone who has just given stellar service to the city. And I just want to recognize that person, Danielle Keneally, who is stellar, has been a backbone for all things legal, and will be greatly missed.
Thank you, Trustee Jen. Thank you. Any other discussion on the motion or the second? So with that, we'll do the roll call vote. Vice Chair Chandra.
Aye.
Thank you. Trustee Horowitz.
Aye.
Thank you. Trustee Jennings.
Aye.
Thank you. Trustee Orr.
Aye.
Great. Thank you. And Trustee Sun.
Aye.
Thank you very much. I also vote aye. So the motion to approve the consent calendar carries unanimously. All right, we're going to go next to item 2, death and survivorship notifications. I'd like to ask for a moment of silence for those who have served the city and have recently passed. Thank you, everybody. Next is item 3, investments, and 3A is the oral update from the CIO Retirement Services. Mr. Palani.
Thank you, Mr. Chairman. Good morning to everyone. We are going to cover performance updates this morning, first by Newberger on private markets as of second quarter, and followed by Makita as of third quarter for the plan itself. But before I get there, I'm very happy to share with the board that 2 of our investment professionals have been promoted. Please join me in congratulating them. This has been a long time coming. The recommendations were made end of last year, and we were in the process of promoting them, and COVID happened, and so it had to be put on the back burner. But they have waited patiently. Firstly, Jay Kwan has been promoted to Senior Investment Officer, and Jay has been with the Retirement Services as an investment officer for over 6 years. He has an undergraduate degree in economics from Stanford and a master's degree and MBA from Oxford in the UK, and brings to ORS several years of private sector investment management experience. And secondly, David Ong has been promoted from Senior Investment Analyst to Investment Officer. David has an undergraduate degree from UCLA, master's in financial mathematics from the Claremont Graduate School, also in LA. And prior to joining ORS a couple of years ago was with the private equity firm KKR. Again, brings several years of private sector experience before coming to ORS. And clearly these individuals have stellar backgrounds, can work anywhere if they wish to, but they have chosen San Jose and public service. And for that, I'm truly grateful. And please join me in congratulating them.
Congratulations.
Here, here. Congratulations. Well deserved.
Yes.
Yes. Thank you very much.
Thank you, trustees. And I'm also equally delighted to share with you our performance fiscal year to date. And of course, Laura and Casey will talk about detailed performance that's actually officially reported. But I also have some unofficial numbers. In October, the plan was down 0.82%. In November, it was up 7.11%. In December year to date, it's up 1.85%. Fiscal year to date, it's actually up an astounding 15%. So kudos to the board for moving quickly in March. We have very, very strong performance. Of course, this does not mean that there aren't risks ahead of us. As you all know, markets tend to be very volatile, especially now with the new administration taking over. There's still a tremendous amount of uncertainty. We have the vaccine. It remains to be seen how quickly that can be deployed and how quickly the economy can be up and running. But on the other hand, we do have a very supportive Fed. So we are closely watching the risks to the portfolio, and we will make recommendations to the board should we feel that some changes need to be made. But I wanted to share those numbers with you. With that, Mr. Chairman, I'd like to invite, unless there are any questions, I would like to invite Casey Boyer to give us an update on private markets through June 30th. But before that, I'm happy to take any questions.
Any questions for Mr. Palani? Okay, we're going to go to 3B, presentation of calendar second quarter 2020 private equity report by Newberger Berman. Welcome back, Ms. Boyer.
Thank you. I am happy to be here. Always appreciate the opportunity to present to you all. Zoom has been actually very helpful in this case, so I can see everyone's faces every quarter. So I will start here on page 2 and just echo the CIO's kind of discussion on performance. We've been very happy with the portfolio to date, and especially during 2020, we've seen some really great generation of performance throughout the year, despite all that has happened and the volatility within the market. So overall, these numbers that you're seeing are Q2 2020 information. We actually have reported Q3 already. So I'll just take a step back and say, overall through the year 2020, we did see a decrease in performance and valuations in Q1. It was down anywhere from 8 to 10% overall, the portfolio. In Q2, which you're seeing here, the valuations did come back. So basically recovered in Q2. And Q3, which you're not seeing here, but I will go over next quarter, and we've already released, is actually up again about another 10%. So overall, 2020, even given what's going on, is seeing some nice return generation. Overall on this page, you're looking at the legacy investments for San Jose Federated. You're also seeing the Neuberger partnership, which is the middle column, as well as the combined information at Q2, currently a net investment multiple of 1.1 times, with a net IRR of 12.2 times, 12.2%. Overall, the commitments we're making, we're right on track with investment pace, following the model portfolio that we put together in coordination with your team, discussing each investment. So very happy with how that has been going, and confident in the commitments and pacing that we have been doing to date. Turning to page 3, this is where you will see the legacy investments. This is benchmarking the performance of the legacy investments to their peer group. So you'll see each investment's IRR and MOIC and how that relates in terms of quartiling to the peer group. A lot of these, as you'll see, are somewhat older investments, anywhere from 10 to 15 years old. So I would expect a lot of those not to move performance quarter by quarter a lot, and that's what we've seen so far. So a lot of these are very similar to what they have been in the past. Moving to page 4, this is the same analysis for the Neuberger partnership. Again, a lot of these investments here, these are newer investments, so you will see a little bit more volatility, but also kind of still very much in the growth phase. So very new investments. We expect a lot of these to move up and to the right. So we'll continue to watch these investments. On page 4 and 5, you'll see both Neuberger investments. Quartiling metrics are only available through 2018. 2019 and 20 are a little bit too new to do this type of analysis. So you'll see those in the months to come, quarters, in future quarters as that develops. As I said, a lot of room here and a lot of time to see what the ultimate outcome will be, but nice to continue and watch the generation here. On page 6, we wanted to give an idea both of where the commitments are within the portfolio, but also to date where capital has been invested. So as you know, when we're investing into primary fund commitments, we make that commitment and capital is invested over 2, 3, 4 years within that specific fund. So you'll see the top left chart is the commitments that we have made into primary funds, co-investments, and secondaries. The chart right beside it to the right is invested capital, and that's how much capital has actually been deployed. So co-investments and secondaries, capital goes into the ground nearly immediately, and primaries are called over time. So that's why you see that difference there. Over time, it will become closer and closer to the committed capital chart. On the far right, you will see both the Neuberger and legacy portfolios combined. So on this page, you get a nice idea of how the portfolio is diversified by investment type as well as geography. You know, a majority of our portfolios are into North America. We continue to see the most opportunities there, the most mature markets, but we do have offices globally, people on the ground in Europe and Asia. So definitely like to include a broad range of investments around the world. Moving on to page 7. So a quick analysis here to break out performance. On the top, you'll see how the fund has performed by investment type. It's very, the returns here, especially IRR, TVPI, exactly what we would expect in terms of early performance generation from secondaries and co-investments. Given those are the investments that are deployed immediately, for instance, co-investments, you make an investment into a company, that capital goes in immediately. And so you tend to see a little bit early generation of returns there. So those two investment types bringing, added performance generation early to the portfolio will, primaries still very early. We're still committing to primaries. We're still committing to all 3 of these asset classes. So over time, these will build. On the bottom, you'll see how the entire Neuberger partnership and how that portfolio is benchmarked compared to peers. So you'll see both the performance at Q2 and Q1. Importantly, the benchmark that we use is only available right now through Q1. So when you see that first quartiling, that is your Q1 performance benchmarked against the benchmark, so that it is apples to apples. You're seeing exactly the same time frame there. So, luckily and thankfully, it's first quartile. Our goal is to keep it there. We think we can do that. So we'll continue to see how that develops. Pages 8 and 9, lots of detailed information. We wanted to provide for each underlying investment. You'll see the gross IRR and gross multiple of invested capital. You'll see where the capital is being deployed in terms of primary fund investments and co-investments over time. And at the very bottom on page 9, you'll see kind of the totals broken out by legacy and Neuberger. So you'll see now the Neuberger portfolio is about 58% of your total commitments. So the new portfolio, Neuberger, is growing compared to your legacy portfolio. And with that, I will open it up for questions.
Okay, thank you, Ms. Boyer. Questions, comments from the board? Nope, hearing none. I think, Mr. Palani, did you want to comment any further?
I have one question.
Yes, Trustee Orr.
No, it's Councilmember.
Oh, I'm sorry, Councilmember Davis. Sorry.
Yeah. I was just wondering if since I know this is private equity and a lot of, I think what a lot of this is about kind of construction type projects. Is this a better time now, given what's going on with the markets and the fact that what I have heard is that commercial lending is a little bit tighter. Is this a better time to invest? Is this a particularly, what are kind of the thoughts about this time and investing in private equity?
Sure. So historically, when we look back at data, investing kind of right after a downturn or a period of volatility. So for instance, when you look back at the Great Recession, 2010, 2011 are really great private equity vintage years. So those vintage years when you're investing actually have produced very good returns. So right now, it's a little unclear what is going to happen over time and how those investments will fare that we're making now. But I think what's interesting is each downturn as we're seeing it has been very different. So I don't think anybody now would have thought when we were sitting in April that investments and performance will be where it has been for Q2 and Q3. We were not expecting to be able to sit here and tell you, your returns are up 10% in Q2 and up 10% in Q3. So I can't tell you exactly, okay, now is the best time to invest.
Sure.
But it is important to look, and we do a ton of analysis on lots of different types of companies. I would say right now, what is also different from prior downturns is when you're looking at specific companies, there's a big variance between the price you have to pay for a very good asset and the price you have to pay for something that's, par or subpar. The really good assets are still going for very high valuations. So you're not necessarily getting, your price arbitrage, I would say. But it is a very good asset. So people are still willing to pay for those. So that's kind of another difference. It's unclear, however, I guess the last comment I will make is that is one reason why we say it's very important to make investments during each vintage year, because we don't know in the end which vintage year is going to be the best, right? So we'll see in the future what vintage year 2020 actually ends up. But from our perspective, very important to continue investing and being diligent just around capital structures and leverage being put into companies.
So you're not, I guess I don't understand the, like when we make the commitments, so this is a little bit newer to me than it is to probably some of the others who talk about this stuff in closed session. When we're making commitments, do we make a commitment of X number of dollars each year that we're looking to invest, and then we don't change that number of dollars based on what comes up? Is that kind of sort of like dollar cost averaging, but doing it in the private equity market?
Yeah, I can answer that, Council Member Davis. So we do have a pacing plan.
Okay.
And we do have an X amount of dollars targeted every year towards commitment, but that is a dynamic pacing plan.
Okay.
And so we actually bring it to the board every year and we revisit the pacing plan. And we do make some adjustments to the pacing plan. Sometimes there are more opportunities and sometimes there are fewer opportunities. And certainly we are not bound by the pacing plan. So if there is a lack of opportunity, for example, we don't force ourselves to make all those commitments. But to Ms. Boyer's point, and this is a classic example of why the Federated plan has underperformed the police and fire plan, if you look at the last 20 years, is one of the key reasons was we did miss certain vintage years in the Federated plan, and we were consistent in making our deployment. So Hindsight's 2020, of course, but I think it's important to be disciplined and stick to a plan.
Thank you.
Sure.
This is Trustee Jennings. So I believe I've probably asked this before, but it's eluding me, so I'm going to ask again. It has to do with the legacy versus the Newburger. And the legacy, it appears, is kind of static. And so we're waiting for it to age out, or it doesn't seem, Rapu, maybe, is legacy ours? I mean, is that what we're investing? You're
Yeah,
shaking. Or
I'll-
Brian,
Casey,
go
I'll
ahead.
take that.
Fine. Go ahead.
So our legacy portfolio is the portfolio of private equity investments that the plans made directly prior to engaging Neuberger Berman in the fund of one. There are two small exceptions to that, but you can think of it like a static portfolio. That the reason you're not seeing it change much is because we've migrated to this highly effective partnership with Neuberger Berman. So we'll continue to report performance on it, and we continue to have some marginal exposure left. But the vast majority, if not all, of our private equity going forward will be within the Neuberger Berman Private Equity Strategic Partnership.
So with the legacy, I mean, the net value is 220, almost 230 million, right? You know, is that right? So
that total value is the current net asset value, which is the total partners capital number, or the net asset value of roughly 35 million plus all the distributions that have been received previously. So our current exposure in the legacy portfolio is actually only 34.8 million.
I see. And so all right, and we're managing that?
At this point, almost every fund in that portfolio is in runoff mode. So they're distributing capital. They're not really calling capital. There's not a lot to do other than wait.
And does it age out? Is that it? I mean, like it's invested and you just watch it? Rabu,
Yeah.
you're shaking your head. So,
Casey, do you want to talk about what happens kind of towards the end of the life of fund investments
yeah,
and fund
I
of
guess I
funds?
just don't understand it. So that's my questions.
Yeah, so that is correct. You basically, you invest into a fund, they make a series of underlying investments. Those investments are realized over time. And what typically happens is at the end of a fund life, 10 to 15 years after they've made investments and they've started realizing and they're coming to the end, there still may be a handful of investments that they're holding on to that just have not fully realized. So typically a lot of the value has already been taken out of that investment, but there's a few kind of lingering investments. What happens is you either wait for all of those investments to be realized, or sometimes people have essentially sold that value on the secondary market. So if you were looking to kind of alleviate yourself from that value and kind of just market off your schedule of investments, you could look into some sort of secondary transaction to do that.
So is there how much, do we know how much longer the 34.8 million is going to be there, or is it going to slowly, like, pieces come away? And then what happens? It goes back into available commitment? I mean, is that when Neuberger gets involved with that money when it's freed up, or?
So the way we handle that is that I expect that 34.8 million number to decrease every quarter. Obviously, we would prefer it to decrease faster rather than slower, but we don't have a lot of influence on that unless, as Casey mentioned, there's some sort of secondary transaction.
Mm-hmm.
As that number decreases, it will decrease the plan's net asset value in private equity. Of course, that'll be offset and probably more than offset by the increasing value of the Neuberger portfolio. The net asset value and the plan's overall net asset value changes and the asset allocation changes will all be incorporated when we redo our pacing plan in May, June of 2021, at which point we will set the amount of commitment to occur within the Neuberger Strategic Partnership for the following year, so that we continue to work towards staying at or near our target asset allocation.
Okay, so, but it transitions over to Neuberger and then they invest.
Yes.
Okay, I'll leave it at that. And I know I have a lot more to be educated on. Thank you.
Brian, just to follow up on Councilmember Davis's question. So is it usually July that we bring the updated pacing plan to the board?
It's typically we bring it to the investment committee around May and then to the board the following meeting. We do try and get it approved prior to the new fiscal year so that we have a clean slate.
Thank you. Thank you. Any additional questions, comments for Ms. Boyer? Okay, well, thank you very much for joining us again. Appreciate it.
Yes, thanks for having me.
Happy holidays to you.
Thank you. Appreciate it. You too.
Thanks. All right, we'll go on to item 3C, presentation of calendar second quarter 2020 private markets report by Makita Investment Group. And Ms. Wyrick is here. Welcome again.
Thank you. Hello. Let's see here. Let me pull up the right report. Can everyone see my screen?
Yes.
Great.
Yes.
All right. Well, good morning. Nice to see everyone. I hope that at some point in 2021, I get to see you all in person again. Didn't think that I would miss the airport, but I do. So here today we have 3 reports. One on the public version of the private markets report to follow up on Casey's presentation from Neuberger. And then we have the full fund pension report and then healthcare. So taking a look at the public version of the private markets report through the end of June, because private markets are lagged, we have a summary on page 2. You can see the legacy private equity, the Neuberger Berman Fund of 1, and then the private debt, real estate, and real assets individual programs. So you can see that almost $1 billion has been committed across all of these programs. However, over $500 million has been distributed. The remaining value is $343 million, most of that in the Neuberger Berman Fund of 1, which you just received the update on. The internal rate of return for each program is on the far right, and then a public market equivalent internal rate of return is next to that. So you can see that the legacy private equity has had a higher return than if you all had invested in the MSCI All Country World Index during the same time periods. Neuberger has had a much higher return than if you had invested in the public markets. Private debt and real estate have had lower returns for the full program, in large part because of some poorly performing funds early on in the programs before all of us were involved, especially your staff currently. And then real assets has had a slightly higher return than if you had invested in the S&P Global Natural Resources Index, which is that public markets equivalent on the far right. And in our footnotes at the end of the report, you can see all the specifics for how this information is calculated. I'm also happy to take questions. Getting into each individual program, the first program that we'll look at is private debt. Commitments by vintage year. You know, as your CIO mentioned, a lot of the private markets programs were sort of not funded for several years in Federated's history, but in the past several years, as you have a fully built out staff and renewed commitment to private markets, there's been more commitments. So you can see here commitments by vintage year in 2018, 2019, and 2020 were higher than the past few years before that, as we try to reach the pacing and the target asset allocation to this asset class. I'll skip ahead to the individual funds. And you can see here that this program and its return too is dominated by 3 funds that were invested back in 2010. They were considered opportunistic investments at the time, but later slotted into private debt. And those are all rolling off at this time. Some of the newer funds are still not meaningful in terms of individual returns since they're newer than a few years, which it takes for a private markets fund to get invested. But you can see Aeromark in particular has a strong return relative to its benchmark or its public market equivalent. Also here you can see graphically how really those three funds from 2010 really have dominated your returns. But as they continue to roll off, we expect the return of this program will more accurately reflect your current team's expertise. The Real Assets program is the next one that I'll show here. You can see that there were commitments in 2019. Also, we had some recent ones in 2020 that haven't shown up yet. If we look at individual funds in this program, there are two Global Infrastructure Partners funds, Lime Rock and Kimmeridge Energy. And you can see here that most of these returns are not meaningful yet, given how recently they were invested. I'll skip ahead to real estate next. Taking a look at the individual funds in the real estate program. Again, you can see here, there weren't any commitments made between 2007 and 2011, but since then, they've been a lot more consistent and we're seeing generally strong returns for most real estate managers. You can also see here that we have ramped up this program in 2017 is the highest amount of commitment capital recently. There really aren't too many other things to note. There's an update on the market environment at the end of this book, which I'm happy to take any questions on, but I think Ms. Boyer gave a good overview of private markets as well. So I'm happy to take any questions on private markets before we move into total pension performance.
Questions or comments for Makita on 3C? Okay, let's go to 3D, presentation calendar, third quarter 2020 performance of the pension fund. Thank you in advance.
Great. Okay. I know that your CIO foreshadowed some of the really strong performance that you've seen for your total fund, but I'll discuss that in a bit more detail. To sort of lay the groundwork here on page 4, you can see the world market environment for the third quarter of 2020 was really a strong returning environment, a risk-on environment. You can see that the MSCI Emerging Markets Index was up almost 10%, followed very closely behind by the US equity market as proxied by the Russell 3000 Index, which was up 9.2%. Even commodities, which have struggled quite a bit recently, were up over 9%. And then followed by small cap stocks, developed international, and even high quality bonds in this low interest rate environment had a positive return of 0.6%. One thing I'll point out on the next slide, which is a theme that you'll remember, I think, from past presentations, but it continues, which is the huge dispersion that we've seen recently between large cap growth stocks, in particular areas like technology, and small cap value stocks. So looking at the 1-year return, the Russell 1000 growth was up 37.5%. That's large cap growth stocks, where the Russell 2000 value, a proxy for small cap value stocks, was down almost 15%. So over a 50% dispersion there between large cap growth and small cap value, which really influenced a lot of individual manager performance. I'll skip ahead to the broad report. And we can take a look. Your fund value is up to almost 2.5 billion as of the end of September. And you can see that asset allocation is very close to your adopted policy targets. Looking at performance, the fiscal year to date period through the end of September, the fund was up 6.2%, outperformed every benchmark that we look at and placed in the 4th percentile, first is best, of the peer group of public defined benefit plans greater than $1 billion. If you look at the year-to-date period, which had a market environment during the first quarter that was down quite a bit, and then a huge roaring market after that point. And as you know, you all had very good timing with changing your asset allocation back at the end of the first quarter, in early second quarter. You take a look at the year-to-date period, up 5.1% and ranking in the first percentile, so the best performer in this peer group, which is almost 80 funds. And also looking at the 1 year, you have an almost 10% return for your fund. also outperforming every benchmark that we take a look at here. I will say that the liability benchmark portfolio, which is long-term government bonds mainly, has, you can see, had a extremely high return. So that is one benchmark that we do look at that has been high. And if you look at the 1 year period, your fund was in the 4th percentile, so top decile, top 5th percentile of the peer group. And when you look down at individual returns of asset classes, you can see why you have these strong returns. Most asset classes outperform their benchmarks for the recent trailing time periods. But I will point out a few individual managers in the next section of the report. Taking a look at Artisan Global Opportunities, they had a return of almost 40% for the trailing 1 year period. One of the reasons for that is they invested in a lot of technology stocks, including Zoom, the platform that we're on right now, which, you know, has become all of our lives recently, I assume, as well as mine. And then looking down at emerging markets outperformed developed markets recently, which is a reversal from what we've seen in the past few years. If you look at GQG, emerging markets in particular, they more than doubled their index return for the 1 year period, with a return of 21.8% and an index return of 10.5. They also invested in more growth stocks, areas like telecom, and also had positive country selection. With that, I'll skip ahead. I wanted to point out one thing in core real estate. If you recall, late last year, or I guess the year before that, your staff, Dinesh, brought a core real estate replacement search. And you all voted to replace your existing 2 core real estate managers with 2 new funds, BlackRock and Clarion Lion. I'll point out here, both outperformed their benchmarks for all these trailing time periods. BlackRock also ranked in the 1st percentile, or were the top fund out of the 26 fund peer group. So I know that one thing we talked about when this search came up is that there's not a huge amount of dispersion within core real estate, but it's very lucky or perhaps skilled to pick the first performing or the top fund in that 26 fund peer group. I also wanted to say a word about risk as well, because your performance not only ranked incredibly well within the peer group on a performance basis, but also had lower than median risk for the peer group as well. So if you look on the left side here, you can see that 4th percentile 1 year return for your fund. That green dot is sort of above this full peer group. And then if you look in the middle one, being above the median for risk means that you had lower risk than the peer group. And then the third section here is the Sharpe ratio, which is a measure of risk-adjusted return. And so you can see that that green dot, which is your fund, had a very, very high Sharpe ratio for the peer group. So not only was your return quite good, your risk-adjusted return was very strong as well. And then I will just end my comments here with the chart of peer performance. You can see, this fund had held a lot of cash, a lot of short-term bonds, had been sort of lower risk than the peer group for a long time. And you can see that in some of the longer term peer relative returns on the far right. But if you look at the trailing 1 year period, and really even recent performance has brought the 3 year above median. But you can take a look here at, 1st percentile returns within this peer group for the year to date period, and 4th percentile for the quarter and 1 year. And that's a peer group here of 77 portfolios. So I'm happy to take any questions on pension performance.
Thank you, Ms. Wyrick. Any follow-up questions, comments on the pension report?
This is Trustee Jennings, and
Yes.
just trying to understand your chart here a little bit. So if we look at this page, the circle is us, is that
That's
right?
right. Mm-hmm.
And the caret is the bench. When you say that's our policy benchmark?
Yes,
Or
that's right.
that's what all right. And then X is the comparative to other investors, or what is?
The X is also specific to you. So that's your investable benchmark portfolio, which is just a passive representation of the way that you're invested. So what you could earn with index funds.
What we could on a passive, passive versus where, all right, so what's the difference between the X and the circle?
So both the carrot and the X are just benchmarks, just sort of paper portfolios that are a way of measuring your actual return, whereas the circle is your actual return. So one reason we show these on here, sometimes your policy benchmark, for example, might include a higher weight to private markets than we've actually been able to attain so far. And so we think it's useful to show, if you were exactly at policy, this might be another way to measure. But you can see here that your performance has, for most time periods, been, recently better than your policy benchmark and your investable benchmark, in addition to the peer group returns.
Okay. Thank you.
Of course.
Other questions? Any other follow-up for Ms. Wyrick on the pension fund? Okay, let's go then to item 3E, the presentation of calendar third quarter 2020 performance report for the Healthcare Trust.
Okay, great. Thank you. I'm going to turn it over to my colleague, Jared Pratt, to walk through this report.
Thanks, Laura. Can you hear me and sort of see me?
Yep.
Yes,
Great.
thank you.
On page 21, if we could just go right to 21. Thank you. So healthcare assets at 326 million at the end of the quarter. That's up 18 million from the prior quarter end. Mostly that $18 million increase driven by investment returns with a little bit from cash flows as well. And then everything very close to policy target here. On page 22, you can see some performance. So the plan is up 5.4% for the quarter, noted here as fiscal year to date. That's slightly ahead of the benchmark. And then for the 1 year period, up 5.6%, slightly behind the benchmark at 6.4. Page 24 highlights a couple of things here. Just if you're curious about the 1 year underperformance, it kind of ties back to the value versus growth comments that Laura made earlier. So the global equity is, you can see what held the plan back for the year. And that's because even though Artisan Global Value did well within the value space, it couldn't overcome a basically insurmountable headwind of being having a value style tilt. And that problem has already been addressed essentially by Artisan Global Opportunities being added over the summer to offset. So there shouldn't be a style tilt in the same way going forward. For an estimate through Tuesday, the plan is up 8.3% for the quarter. So if you kind of pair that with the 5.4% you see here, you get a fiscal year-to-date return of over 14%. And then I'll skip ahead maybe to page 35 and 36 because those are new to this report. 36 in particular is maybe more important to conversations that we've had in the past, just pointing out that the healthcare trust is more aggressively positioned than a lot of other healthcare plans. And you can see that here, where equity has a relatively higher allocation than peers, and then fixed income is low. So this a new slide we added just to show that. And then coming up in early 2021, we'll be addressing asset allocation for the healthcare trust alongside the pension plan. So just pointing out a couple of new pages here. And with that, I'll see if there's any questions.
Okay, thank you very much, Jared. Any follow-up questions on the Healthcare Trust Fund? Okay, not hearing anything. So thank you very much, Laura and Jared, for coming today, joining us today, and appreciate the reports.
Thank you very much. Happy holidays to anyone.
Happy holidays to you too. Thank you. All right. So we went through those in terms of the agenda. We went through those the investment reports fairly crisply. So unless there's any objection, I think we should try to tackle item 4 before the break. Anybody have a resistance to that?
Sounds good.
Okay, I think we're okay. So for item 4, old business, 4A is discussion and action on final pension valuation results as of June 30th to be presented by Chiron. Mr. Hallmark is here. Welcome. Mr. Hastings. Yes, hi.
Good morning, everyone.
Good morning. Welcome.
It's good to see you, even though it's all just on Zoom. I'm going to share my screen here in just a second. All right, so hopefully you can see my screen now. So yeah, I have Stephen Hastings with me to present the final evaluation results. Jackie was not able to make it today. A lot of this reiterates some of the decisions you made at the last meeting, but we provide a little more depth in the final evaluation results. So just as a reminder, we want to start with the graphic about how the pension system works and the valuation, where we take the census data, apply assumptions, take an assessment of the system. We've got investments coming in, actual and projected future investments, and then the projection of benefit payments and expenses going out of the fund. And the real focus of the valuation is how we should turn the knobs on the employer contributions. And so we have a policy about how we do it, but it's based on our assessments. So if we look at the funded status of the system, it went from 53% to 52%, reflecting both the assumption changes and the experience during the year. The bars here on this graph show the liability, where the dark blue is the liability for members who are currently receiving benefits. The gold is for members who are no longer working for the city, but are entitled to a future benefit. And the red is for the active members who are currently working for the city. And then we use both market value of assets and an actuarial value. The actuarial value, as you recall, smooths investment returns over a 5-year period. During this year, they moved largely in parallel. The chart on the right, or the table on the right, gives you details broken out by tier, but you can see that the everything kind of moved in tandem, but the unfunded liability on a market value of assets basis increased to about $2.2 billion. So that's what we're trying to pay down, and that's largely the focus of much of the contributions. So if you look at the contributions and how those have changed, this valuation sets the contributions for fiscal year end 2022. As a rate of pay, the total city contribution went down. Now that's largely because we've increased the number of members and increased salaries more than we expected. And so the payroll is larger. The purple bars represent the member contribution and the city normal cost contribution. And you can see as a percent of pay, the city's normal cost went down. That is largely because we get more tier 2 members in, and there's a lower city normal cost for tier 2 members. And so we're going to see, we've been seeing that, and we'll continue to see a small decrease each year for the city in terms of their normal cost rate. And similarly, you see a small increase each year in the member contribution rate. And that is because of the shift to tier 2 as well. The gold bars represent the payment on the unfunded liability. The dark gold is just paying the interest on it. So the unfunded liability would increase each year with interest at our assumed valuation rate, which is 6 5/8. And so we need to pay almost 40% of payroll just to hold that dollar amount the same. We're paying 6.3% of payroll on top of that to reduce the dollar amount of the UAL. And on the right-hand side here, we show the actual dollars. So you can see that that applies about a $22 million payment to reduce the UAL. And recall that's on a $2.2 billion UAL. So it's a tiny payment, but we start chipping away at it and it will gradually decline. So this right-hand side shows the total increase in the city's contribution is about 15 million over the prior year. So even though it's a lower percentage of payroll, it's an increased dollar amount. And again, you can see the dollar amounts for the different components as well. Now, not all of that increase, 15 million, was unexpected. So here we're showing what the contribution was for fiscal year in 2021, 191. We expected that to increase to 198.7 million, just because of our smoothing in some investments and some of the amortization changes. When we actually got census data, excuse me, and did our analysis, though, the contribution increased to 204 million. And so that reflects the investment returns through June 30th, as well as the salary increases and the additional payroll. Then last month, we adopted changes in assumptions that increased it by another 1.8 million. So with that, I'll turn it to Stephen to talk about some of the tier 1, tier 2, and the sources for the changes.
Okay, hello everyone. I'm Stephen Hastings with Chiron. And on slide 6, we, as Bill just mentioned, compare the tiers. So if you look at the upper left, we're showing member counts. The green is tier 2 and the blue is tier 1. So you can see that the active counts are similar. Actually, well, the tier 2 is now more than the tier 1 active group at 23% versus 16%. But the vast majority of the in-pay participants, so the retirees, beneficiaries, et cetera, in payment, are tier 1, and that's 45% of the total. I believe there are 13 tier 2, so they don't really register, 13 total tier 2 members in payment, so they don't really, as of the valuation dates, they don't really show up here. And then there are what we're calling VT, which is vested terminated participants. So those are participants that have left employment but are due a benefit sometime in the future, not yet in payment. But again, I want to focus on the active counts there, 23% for tier 2, 16% for tier 1. Now, if we look at payroll underneath on the left, you can see that similarly, the tier 2 is the larger portion, although it's getting close to 50-50. But the tier 2 group has overtaken the payroll. So that's active members and active payroll, but it's a very different picture when you look at liabilities and assets. So if we look at the upper right, we're showing liabilities. So here, tier 2 actives are only 2% of the total plan liabilities of, say 4.4 billion, and 70% is for the folks that are retired and in payment. The tier 1 actives are 23%, and then the vested terms don't really show up for tier 2, but they represent about 5% of the liability. And then underneath we show the market value of assets, with tier 1 having 95% of the assets and tier 2 having 5%. So the reason we wanted to show this is even though the active counts are similar, the point we want to make is that it takes a long time for these liabilities to accumulate, and for the changes to have an impact on the system itself. So tier 2 has been in place for 8 years now. September of 2012, I guess, is the cutoff. So again, it's only 5% of the assets, and a small portion of the liabilities at this point. So if we move to slide 7, so here, similar to what Bill discussed earlier, but here we're showing the contributions, the dollar amounts by tier. So it's a little bit busy, but what we have on the left is the fiscal year end 2021, and on the right, the 2 bars are for fiscal year end 2022. So as Bill mentioned, the valuation we just completed will be used for fiscal year end 2022. And what you can see is the yellow being the UAL, which is the unfunded actuarial liability, the payments on that unfunded piece. Those increased significantly for tier 1. And that's the largest portion of the increase we're seeing. So the city total going from 176.6 to 188.5. Again, the bulk of that being the unfunded amortization payment. The normal cost, as Bill discussed, dropped a little bit. So that's the dark purple. And then the member portion being the bottom lighter purple. So 10.5 in tier 1 and 14.3 in tier 2 for 2021, going up to, dropping a bit to 10.3 tier 1 and increasing to 17.5 tier 2. So similar to what's going on with the normal cost, that is due to more members coming on into tier 2. Okay. So, well, I was just going to say that, so the text on the right, sorry, back a slide. Yeah, so the text on the right just summarizes what I was saying there. About a 12.3 million of the dollar increase was due to the tier 1 UAL payments increasing, and Bill discussed some of those reasons. And those include some of the asset losses and assumption changes, and then the expected payment growth, right? So the amortization payments increase as a percent of payroll. Okay, so on slide 8, we look at the contribution rates. So here on the left, we're showing several numbers, but the second column being fiscal year end 2021. So you can think of that as last year's results, and the third column being fiscal year end 2022, this year's results. And then we run through the various buckets here. For member rates, in these, kind of a footnote, we're not including there are a few participants that have these reclassification payments. We're not including those here, but the member rates increased a little bit. And in the second section here, the city rates and amounts, we show, again, the UAL increased 12.2 million. There was a small decrease in the tier 1 normal cost and administration payments in dollar terms, and a small increase. And then for tier 2, there was a $3.2 million increase, and the contribution went up 0.25%. So from 7.92% to 8.17%. In aggregate, as Bill mentioned, the dollar amount increased 15.1 million roughly, but the city portion rate dropped from 59.16% to 58.56%, and that's a function of the increased payroll. So the increase, there were salary, some losses for salary increases with the larger payroll as a percent of pay. The rates actually decreased some. Okay, so on slide 9, here the blue bars are the unfunded actuarial liability. So not the total liability, but just the piece that is unfunded. And what we're showing here are how things changed from 2019 to 2020. And in the middle, we show the pieces. So the bar being the blue line being no change, and then amounts that are above the line are increases in the unfunded, and amounts that are below the line are decreases in the unfunded. And with the scale here, we show from 0 all the way up to 2.2 billion. We just want to show that these aren't massive changes relative to the unfunded itself, but they do matter. So what are these items? Well, the reductions included contributions. That was a $21 million reduction, and what that is contributions over and above your sort of tread water rate, right? Your normal costs for new accruals and interest. If you pay more than the sum of those two pieces, then you're actually paying down your unfunded, and so 21 million was a decrease there. And then there were several items that increased the unfunded. Investment losses, that was the largest one, 68 million. Salary, 26 million. Retirement and termination experience differed from expected in a way that increased liabilities a bit, 8 million and 7 million respectively. And then, there were some other pieces there, 3 million, but the assumption changes actually increased the liability by 37 million as well. So up top, the yellow, gold being the investments and the purple being the assumption changes. Those are the two biggest items, and we'll see that flow through to the next slide as well, which shows similar results, but historically. So again, the prior slide shows that in a given year, those changes aren't that, but they don't seem very large compared to the unfunded itself. But if you have a pattern of amounts that increase every year, they can add up. So here we're showing the changes to the UAL year by year, and again the bar along the bottom being 0, no change. So anything below that, any amounts below that are decreasing the unfunded, and amounts above it are increasing the unfunded. So, and I guess what I would like you to focus on here are the two colors, the purple and the gold. So the assumption changes over the years, and the investment return, the investment experience. So you can see that with the exception of 2014, the investment experience is above the 0, right? So there were losses in most of the years there, and then assumptions. So some of these are demographic, which can be significant, mortality and that sort of thing. But a lot of the purple is due to discount rates coming down over the years. And in total, well, so the net change is the dark blue that follows along. But in total, we summarize the totals at the bottom. So the total increase in UAL over this time period from 2011 through now is 1.3 billion. And, slightly more than half of that was due to assumption changes, and 575 million of that was due to investment returns being on the actuarial value being less than assumed. And then there were other amounts, contributions not, the red is contributions not being enough to meet the tread water amount. And then there are some, some other items there, liability experience, which sort of nets, which you would hope liability experience, sort of if your assumptions are operating the way you want them, there shouldn't be a consistent gains or losses there. And then the final item being benefit changes.
Steven, this is Roberto. Could you go back to the slide again, please?
Sure.
And could you explain for everyone benefit, what do we mean when we said contribution less than the tread water amount?
Sure.
Thank you.
So the next slide will be instructive as well, but there are several pieces in the that we calculate in the funding of the pension plan. One being the normal cost, which is the accruals during the year for another year of service for all the active members. And there are also the administrative expenses that are charged to the plan. And on top of that, there are the amortizations that are meant to pay down the unfunded actuarial liabilities. So the difference between your liabilities and your assets. And what we call the treadwater level is the interest on the unfunded actuarial liability and the normal cost and administrative expenses. So if you don't make a contribution that at least covers your normal costs, so the new accruals and the interest on the unfunded. Oh yeah, so Bill went to the slide that shows the pieces. If you're not at least making, I guess the purple normal cost up through the dark gold, the interest on the unfunded, if you're not at least making a contribution in that amount, then you're actually going backwards in terms of paying down your unfunded. So you have negative amortization. And that was the case for many years, but the plan actually crossed that threshold. I think it was last year for the first time. And you can see in the slide 4 that Bill pulled up that some principal is now being paid. So that's the light yellow at the top.
Understood. Yeah. Thank you. I just wanted to make sure I figured that's what you were referring to.
Okay.
But we don't use that term too often. So I wanted to make sure for the benefit of board members and the stakeholders in general.
And
Not to be confused with, maybe there were not enough plan sponsor contributions, right? That's not the case. I mean, they pay what they were supposed to be paid or the invoice that we send them. So I just wanted to make sure that was clear.
That's right. The city paid what the retirement system asked them to pay, but we were using a long amortization period. It used to be 30 years as a level percent of pay. And so those initial payments were less than interest.
And this is Trustee Jennings. So the city is looking at many ways to bring down the unfunded liability. And if they were to make a sizable payment to it, then the interest would go down. Because if, let's say, they paid 80% of it off, that would be a lot less interest they're paying. Depending how they come up with the money, that's the challenge of what that interest would be versus the 6.75 or 6.65 that we're doing now, or 6.6?
65.
6.625.
6.625. So if they were to come up with interest less than that, they would be saving money. They wouldn't have that 139.4 if they paid it all off, right? I guess point blank.
Yeah, if they paid it all off, that would just, this whole gold bar then would disappear. And the normal cost going forward.
Yeah, you will go down by $161.6 million.
Yeah, but that's $2.2 billion to pay it all off.
Right. But of that, if they were to do that, the 139.4 would no longer be money.
Right. And so we'll show that in our projections that, we're chipping away at the principal, and each time we chip away at the principal, then the following year it reduces this interest payment. And so you can chip away, you can pay more and more of the principal over time.
And Stephen, you were going to go to that next screen, and I assume now you're showing like more of the forecast. And as the tier 1 age or die off or whatever, they're not going to have as much of a pool. They're not, the in pay, right? I think is what we call them, or whatever. Yeah, so that then will lower it substantially, because then you'll just have tier 2, but it's waiting it out, right? Is it waiting it out? And then the unfunded liability goes away. I mean, is that like, I guess my thing is there's a choice. The city is looking at that. do we find an alternative funding source, which is what the mayor is looking at. And that would deal with it right now or in the next couple of years and save a lot of money on the interest over these future years to get us to like what, 2040, or eventually into what, 2039, we don't have that unfunded liability. Is that because tier one is not going to be pulling? Or are we just going to pay it off?
Well, so what we're showing in slide 11 is the layers of amortizations, right? So there are new layers that come on every year, and the dark blue was a sort of a reset, a 30-year amortization of what the unfunded was back in 2009. So that's the bulk of what you're seeing there, right? Or the largest piece. And then on top of that, there are layers for assumption changes, which are paid off over 25 years, and then demographic and asset gains and losses. Those are also, or those are over 20 years, sorry. So 25 for the assumption changes and 20 for the gains and losses. But with the largest one, when that gets paid off in 2038, you can see there's a cliff, and you know that's 18 years out still. So it's not an immediate concern about, hey, you know, what action do you want to take, or but at some point, yeah, there's probably should be a discussion there. So this is paying off what's there now. Now, in the future, to the extent there are demographic and economic gains and losses, those will be amortized as well, and assumption changes will be amortized as well. But yeah, the big piece is trying to pay off, you know, dig out of the hole you were in 2009. Basically, is what's happening there. And at the bottom, you can see the tier one balance as it drops over time. That's the unfunded amount. And I don't know if Bill wants to add more color there, or.
Well, I just want to add, if the city does make a substantial payment, it would, according to our current policy, that additional payment would get amortized over 20 years. But I think we would probably bring that specific question, if they made a large payment, to this board to figure out what amortization period should we be looking at. Should we match it up, for example, with this 2009 piece, so that smooths out some of the amortization? Or if they issued a pension obligation bond, do we need to match it up with the terms of their pension obligation bond, so that it matches their payments on that? So that's, you know, nothing to discuss today really, but just making sure you're aware that if the city does do something like that, we will bring a question back to the board. But we'll have to get a whole lot more information before we can make any recommendations.
Bill and Stephen, Councilmember Davis raised her hand. She may have a question. Yes, you're welcome.
What is that 2009 UAL amount? Just that, what's the value of the blue bar?
Value.
I'm gonna let Stephen look that up because I'm sharing my screen. And I don't.
Yeah, I will look that up. Actually, I believe we have it in the reports.
Yeah, it should be in the report. It's also in the projection model.
Looks like it's at least, well, lower than 50 million, huh?
Well, it'd be the size of this blue bar right here.
Oh, right there. Yeah. So, oh, well.
750 or so.
750, yeah, 752 million outstanding balance. 753, I guess, if we round.
Okay.
And the payment is 57.7 million for the latest valuation. Now that increases at 2.75% a year.
I'm sorry, can you say that again? Sorry, I was, it cut out. The payment,
The outstanding balance for the 2009 UAL amortization is 752.7 million,
okay,
and 19 years remaining, and the payment is 57.7 million as of the June 30, 2020 valuation, right? So that payment amount increases over time.
and you said the percentage, that was the part I missed, the percentage that it increases, the
Oh,
payment.
yeah, the payment increases at 2.75%. So it's meant to keep it at a level percent of payroll, but there's a little margin built in there.
2.75%, you said?
Correct.
I think it would be helpful to have this discussion as opposed to us making the decision about pension obligation bonds in a vacuum and then you deciding what happens to it after the fact. I think it would be beneficial for us to discuss it all together because the city may be making an assumption about pension obligation bond and what it will do to reduce the UAL that then the boards decide something completely different that it doesn't actually end up doing. And that may make the difference about whether or not we want to use the pension obligation bond as a mechanism to reduce the UAL. So I would just like to request that this board keeps the conversation open and that we have those discussions about pension obligation bond and how it would be used, applied to the UAL, to have that decision be made in conjunction with the city council so that the city council is not making a decision about pension obligation bond and whether or not we do this thing that frankly I still have reservations about, and that it is going to matter to me how much it reduces the UAL and how it is applied as to whether or not I decide to vote for it or not. So I just would like to put that out there that I appreciate Bill saying, you know, when the council decides or if the council decides, then we'll bring this to you. I don't think that's the right answer. I would really like it to be a lot more cooperative than that. So I would like that.
Yeah, I didn't mean to imply that it would be after the fact. It's just, we haven't seen anything yet. At this point, my understanding is the city's just going through the process of getting approval to do that. And we have been involved in some discussions about how that might be credited, but we need to talk with the city about how they want to, how they're structuring their bond payments, and then talk about how that affects what's done here.
I completely agree. I just want to put it out there as the liaison, as the council liaison, that I would like there to be liaising.
You're doing
a handoff.
You're doing your job, Ms. Davis. Thank you very much. I just wanted to add two things. Number one, Bill, I did forward to Councilmember Davis your spreadsheet presentation that you made at the retirement working group. And then number two, Ms. Davis, as far as I understand, there might be a POB study session scheduled for the council in April. Is that correct? April 2021?
Yes, that's the current when it will be.
Yeah, and so I would just recommend, and you know, obviously we can speak offline and work on this, that you know, the council can also receive an additional presentation that same day from Bill. I'm sure he'd be very excited about making one because I think I think what happens here, and I don't want to speak for Bill, the different options that may be presented to the board are, I'm assuming they're directly related to not only how the POB is structured, but really the amount of it. And
right.
so that have implications. But I think so that the council have a full picture as you are recommending, maybe they want to hear from obviously the city personnel on this structure in the POB, and depending on different options, maybe they can also hear from Bill about various considerations that the boards may consider depending on how the bond is structured and the amount that is being issued. I don't know if you have any other comments, Bill. I don't want to speak for you on that.
I would just say we should also loop in Prabhu because it's not, I guess it's probably assumed, but it isn't necessarily the case that any proceeds from a pension obligation bond would be invested in exactly the same way as the current portfolio. And so that should also be coordinated as part of the whole process.
Thank you. Yes, I would very much appreciate that. I mean, for those of us who whose only experience is with, if I make an extra payment on my mortgage, it reduces my principal by exactly that amount, and decreases my overall, overall payment of interest over time. It's a little bit different to think about amortization and applying a payment now, amortized over time. It's a little bit harder to wrap our heads around that. And frankly, I would want to know exactly what the board would be considering, and also even more so what Chiron would be recommending to the board, because you do make those recommendations. So that would be important for my decision making, and I dare say for the rest of my colleagues. Thank you.
Well, I agree in many ways with Councilmember Davis. I mean, if we're doing something like this, it's to bring down the UAL and interest and make sure that who funds, a major part of the retirement is healthy enough to keep on going, right? So, given, and I think the city is exploring it. And I think it's just an exploration at this point. Julia is taking a good eye, and, if the interest rates are really that low and our, our amount is higher, then there's a savings, at least in the near term. I don't know how that plays out long term. But the whole benefit is to bring that down so that we don't see this. But I don't know. I don't get the impression the city would be going for the full amount. Plus, this is just Federated and not police and fire. So I think Bill is also kind of alluding to what does the final numbers look like? What would we go forward with? But it has to be collaborative. Yes, I totally agree. Thank you.
And you're right. The full amount is basically pretty much off the table, because it is such a large amount, and B, it increases the risk. The more that we put out in bonds increases the risk to the city. So there's talk about the number that's been kind of just thrown out was 250 million. And there is also talk about directing it specifically to Federated because of the level of funding of this fund compared to police and fire, which has a higher percentage of funded. So even if we did 250, we might do 250 and it might all be directed to Federated because of the funded amount for this fund compared to police and fire.
Roberto, also, could I ask that you check in with Cheryl Parkman, since I believe the plan is she'll present a draft report for Retirement Solutions Working Group in January, just to be sure that there's not an overcommitment of how the PLB might look, but that there's still room to maneuver vis-a-vis Councilmember Davis's concerns. If you could check with her. Yeah.
Yes.
Thank you. Okay.
All right.
Bill and Stephen,
Yeah,
shall
let
we
me
proceed? Yeah.
move on here. One of the issues that we've talked with San Jose about is the maturity of its plans. And this is particularly the case for police and fire, but also we think Federated should be aware of the potential issues. And the overriding point is that as pension plans mature, they become more sensitive to risks, whether that's investment returns, changes in assumptions, other kinds of experience. And by more sensitive, what we mean is that the same outcome will have a bigger impact on their contribution rates as they get larger. So the first measure we look at, because it's relatively intuitive, is called the support ratio. And it's really just the number of members who are not still working for San Jose divided by the members who are working for San Jose, because all the liabilities are in one pot and all the assets are in one essential pot. And when there are gains or losses on those, it is the payroll base of the current active members that has to make up for those losses or gets credited for those gains. And so this top chart shows the Federated history. And the dark blue bars are the active member count, the tier ones. And then the teal are the tier 2 active members. The gold are the deferred vested, and the green are the retirees. So you can see from this that the active membership remained relatively constant until 2009, and then we had a drop in active membership. And that has gradually started to recover. But at the same time that we had that drop, there was a significant increase in the number of retirees and deferred vested. So this red line is that ratio. And you can see starting right after 2009 to 2012, it just shot up. Since then, it has stabilized and there's even a slight downward tick here at the end, but mostly it's just stabilized at this higher level. The chart on the bottom shows essentially that red line compared to about 200 public plans nationally. So this is information taken from the public plan database. And so the bars show the range of the measure in all of those plans across the country. The black diamond is the Federated plan, and the gold diamond is when we combine Federated and police and fire. In this measure, they follow pretty similarly. You can see in 2009, then San Jose's numbers shot up. And so we went from being kind of middle of the pack, maybe a little bit high, to being at the higher end using this measure. The next two measures are what we call the leverage ratios. And the first one is the asset leverage ratio. And it's simply the dollar amount of your assets divided by the dollar amount of the payroll. And what that tells you is how sensitive you are to investment returns, particularly in terms of how it affects payroll. So as an example, let's say that ratio is 10. So you have assets equal 10 times payroll. That means if you had a 10% investment loss, that loss compared to the assumption, so we're assuming 6 5/8, that'd be a -3 3/8 return. So if you had a -3 3/8 return and your ratio was 10, that loss is equivalent to 100% of payroll, 10 times 10%. If that ratio is only 5, that same loss is only 50% of payroll. Well, if we're setting contributions as a percent of payroll it's a lot easier to make up 50% than 100%. It'd be twice the contribution rate increase to make up that 100%. So here we're showing the range for those national plans compared to Federated is the black diamond, and the gold diamond is when we combine police and fire. And you can see that after 2009, we've been high for a while, but after 2009, we really spiked up and are we're not the highest in the country, but the top of this is the 95th percentile. So there are only 5% of plans above the top of these bars. And so San Jose has been up there. And so that means on the whole, if we have variations in investment returns, it's going to have a bigger effect on our contribution rates than it would for other plans. The liability leverage ratio is just the actuarial liability divided by payroll. And so if we were 100% funded, these ratios would be the same. They'd equal the liability leverage ratio. And so, but in addition to that, this shows in particular, when we make assumption changes, how sensitive your contribution rates are to that. So like if we reduce the discount rate, it's going to have a bigger impact on San Jose's contributions than it would on other plans' contributions. So, and here, when we include police and fire, we're really quite a ways above sort of what the range of plans nationally are. So these are kind of the indicators of why we talk about that sensitivity at San Jose. We talk about it a lot more with police and fire than with Federated because the police and fire system is much higher. But it's just to be aware that you are sensitive to those returns in terms of how it changes your contribution rates.
Bill, this is Trustee Jennings. Is that sensitivity, are we so high up because we have so much more in pay than active? Is that what's driving it?
That's a significant part of it, yes.
Okay, and that happened in around between 2009 and 2011 when a lot of people, I mean, that was what, Measure A, you know, when that went forward, a lot of people in the city retired, left, not be impacted by it. So that effort just, well, it did two things. It pushed people into retirement. It also brought about eventually Measure F, which brought about Tier 2. So that also lowered the obligation. So it's kind of like a kick in the teeth, and then eventually, I guess it's helping to bring down.
Yeah, I think one thing to keep in mind here is we use payroll as the denominator, but really the intent is that that is a proxy for the revenue levels or the resources available to support the plan. It's not it's not so important literally the payroll as just what resources are available to support the plan. And we could use a different measure for San Jose because we could agree on what revenue measure we want to use or what other measure we want to use for that. But doing that nationally is just impossible, especially for the statewide plans that may have 1,000 different employers in them and stuff. So we use payroll as kind of a proxy for that. And so part of it is not just, not directly what happened with people going into pay status, but think about what happened to San Jose's revenues during that period. They were flat or falling, and then they've grown back some. But ultimately, this is really about the size of the plan compared to the size of San Jose and its budget and revenues. That's the important comparison. and payroll is a rough proxy for that. So it's not a perfectly accurate measure.
But Bill, most, if not every other system, they use payroll.
Yeah,
No.
almost all public systems collect
Yeah.
their contributions as a percentage of payroll.
Yeah. I just wanted to make the point so that, you know, we're using it as a proxy, but it's just to be consistent in terms of the, as well in terms of the results, right? So there's apples to apples. Okay.
Yes. So we wanted to show you some of our projections. This shows the projection of the liability compared to the assets. The green line here is the smooth actuarial value. They are very close in this time period, so it's hard to see any difference. And going forward, if we get our assumed rate of return, they become the same very quickly. The dark gray bars are the historical, and then you can see the funded status. So if all of our assumptions are met by 2035, we're projecting that we would be 84% funded. And if you looked at the actual unfunded liability, you'd see this projection. So we're projecting it to stay fairly level. This is on the actuarial value of assets, so we still have some investment losses to incorporate in that number, but then to be paid down and paid off around 2040. These are the contributions. The purple bars are the member, the gold, the city. The black line is the normal cost rate, which we're still expecting to come down for a little while before we're dominated by tier 2 people. This blue line is that treadwater rate. So going back to that discussion about, you know, we pay off a little bit more and then the interest on the unfunded liability gets smaller. That's what you're seeing here, is that that interest on the unfunded liability is going down as we tick it off. And so we pay more and more of the principal off. And then Stephen showed the slide with the amortization payments, and this is where that 2009 amortization payment goes off. So that's why we see the significant drop there. As a percent of pay, we're expecting this to remain relatively level with a slight decrease each year. And that's because we are projecting payroll to grow by 3% a year, but the amortization payments go by 2.75. So you have that difference plus a slight decline in the normal cost. However, the bottom shows the dollar amounts, and the dollar amounts are expected to continue to increase. So even as payroll goes down, we've got increasing dollar amounts for several years. And then ultimately, you get a significant drop after 2040. Now that's if all of our assumptions are met. And so here we did a stochastic projection with investment returns and used a 13.6% standard deviation for your investment portfolio. The middle shows, whoops, I'm sorry. The middle shows sort of that projection that you saw before over the next 15 years, but there is a significant range based on those investment returns. So when you get out to 2035, you're looking at a range between the 5th and 95th percentile of below 10% of payroll to like 85% of payroll. So ultimately, those investment returns make a big difference in what our contribution rates are. Here, we're showing the same information split between tier 1 and tier 2. We put them on the same scale so that you can see that tier 2 we're not, even 15 years out, we're not seeing much variation due to investment returns. We'll get bigger variation based on what tier two's actual payroll is and the number of tier two employees. But even as the active workforce is dominated by tier two, the contribution amounts are going to continue to be dominated by tier one, unless, of course, we get great investment returns that could drive the tier one contributions down near zero, but they could also be pretty close to 400 million a year compared to the current 200 million.
Bill, it's Megan.
Yeah.
I'm trying to understand this chart, the one on the top. So the contribution amount, I mean, what's the green again? I don't understand this.
So this is the range of contribution amounts depending on actual investment returns. So, we're projecting 6.625% returns, in which case we'd follow pretty close to this black line.
Okay.
But investment returns could be much higher or much lower. And
if they're higher,
it could drive your contribution rate all the way down to almost zero for tier one. And if they're lower, it could go up from the 200 million today to 375 to 400 million in 15 years.
So what's 75th to 95th mean? I don't.
So it's the percentile of returns. So we rank order the returns. And so if you're in the bottom 25% of returns, you'd be above this line right here between the light red and the dark red.
So why is that 75th to 90? I don't know. It just seems to me like if you're in the bottom, won't you be on the 5th to 20? Is the 5th to 25th
Yeah, there's a
higher? Is that better? It's like you want to be.
Yeah,
Miss Jennings,
is better.
Yeah, it's like, remember when we had a discussion on the pension results presented by Nikita? And in the most recent, I don't know if it was the quarter of the year, we were number 1 percentile. 1 is the best, it's the highest.
Okay.
99 is the opposite, is the bottom. So that's the same here.
Okay. All right. Sounds good. I was just.
So if you continue to get first percentile returns, then it will drive the contribution down.
Okay. I got it.
And Prabhu promised that for the next 8 quarters, I think. So I'm not sure. I don't want to hold him to it, but I think that's
I
what he
feel
said.
no pressure. Thank you, Roberta.
You're welcome.
Hey, quick question. I'm sure this has also been answered before. I can't remember where to find in the chart. The breakout between tier 1 and tier 2 staff, just the number. Do you guys have that handy? And if you don't, you can always just send it to me later.
The actual counts.
I was just curious, and I don't need it right now. If it's not right in front of you, please. All of a sudden made me think about it as we're looking at the 2 charts and comparing tier 1 and tier 2. I just couldn't recall the number of staff.
Yeah, it is in the report. The active, so we're showing total actives of about 3,700, with 1,500 of those being tier 1 and 2,200 being tier 2. Roughly, this is on page 2 of our full report. And then if you include the inactive members, which are almost, almost entirely tier 1, but the total membership is roughly 9,800. So you have.
Thank you for that clarity.
Okay.
So I was going to switch here to the interactive model just to, but I think I have to unshare my screen and reshare. So hang on just a second.
Yeah.
Okay, are you seeing the projections here?
Yes, thank you.
So just to illustrate the sense, this is the same sort of graph we showed in the PowerPoint of these are the liabilities, the assets, the gray bars are the liabilities, and then at the top we showed the projection of funded status. The bottom chart shows contributions where the purple is the member and the gold is the city, and the red bars from the last valuation, which shows things to be very similar. On the left-hand side here, we put in, we can put in actual returns. Right now, it's what we assume. And so just to give you a tease, since we're at 13% so far this year, that would begin, if we could hold that to June 30th, 2021, that would begin to affect contributions in 2023. We'd recognize the gains over 5 years. And so then you'd see this ongoing impact reducing contributions. So good returns definitely make a difference and help in terms of the city's budget. You know, similarly though, if we have poor returns, it will drive the contributions up.
Does this model also show if you make a large payment?
I don't have that option set up right here, but I did for the, I think it was for the Retirement Solutions Working Group.
Yeah, Councilmember Davis was interested in seeing that.
So I didn't anticipate that for this meeting, but we can certainly, when we come back, and especially if we're talking about the pension obligation bond, then we can look at different impacts and also how the amortization of that is affected. So that's it on the pension. Are there any questions?
Any questions from board?
This is a trustee son. I have a question.
Yes.
Hi, Bill. I actually don't know if my question will make any sense. I remember last month when we talked about the assumption changes. I remember their baseline with no change on the assumption, and also assumption to change the discount rate from 6.75% to 6.625%. I remember the variance between those two scenarios were $4 million. But today, based on your presentation, page 5, this difference is up to $1.8 million. I'm just kind of wondering what changed.
I don't have the details of the other pieces in front of me, but there were also changes to the mortality projection scale and the price inflation. Can't remember if there were any other changes, but those reduce costs. And so I think when we were looking at just the change in the discount rate, it had a bigger impact. But when you combined with the other changes that were reducing the cost, the net was smaller.
Okay. All right. Thank you.
Other questions, comments? I was looking, Bill, in the PowerPoint. I thought I saw a slide where we specified impacts of the decisions we made last month. No. Do we have something that captures those?
The
impact of changing the discount rate, the inflation rate, the amortization rate.
So, slide 5 had it in aggregate. I I don't believe we broke those out if you're asking.
Okay.
Yeah, this was the aggregate impact of all of
the, yeah.
Last month, we did present kind of breakdowns of different components, I think.
Yeah, okay, thank you. All right, other questions or comments for Chiron? All right, so this is this is on the valuation results on the pension plan. We're going to deal with the OPEB shortly. So let's follow through on the commitment to take a very short break, 5 minutes. It's 11:57. We'll come back at 12:02, and then we'll jump back into starting with item 5A. I'm sorry, was there some?
Yeah, Mr. Chair, can we have
Yes.
a motion on this particular?
I'm sorry.
Yes.
Yeah, my apologies. So on this item, it's discussion and action. We need a motion and second to approve the final pension valuation results as of June 30th, 2020.
Trustee Jennings put through a motion to approve.
Thank you, Trustee Jennings, for the motion.
I second that.
Okay.
Trustee Horowitz.
Trustee Horowitz, thank you very much for the second. Any other discussion from the board, from the public? Let's do the roll call vote. Vice Chair Chandra?
Aye.
Thank you. Trustee Horowitz?
Aye.
Thank you. Trustee Jennings?
Aye.
Thank you. Trustee Orr?
Aye.
Thank you. Trustee Sun?
Aye.
Thank you. I also vote aye, so that motion carries unanimously 6-0. All right, 5-minute break. Please be back at 12:03. We'll get going with item 5. and resume. We are on item 5, new business. If there are no objections, I'd like to, is Councilmember Davis back also? Okay. I'd like to suggest we keep our momentum going by jumping right into item 5C, the discussion and action on OPEB methods and assumptions by Chiron, and then we will double back for items 5A and 5B. Any objections to that? All right, so with that, Mr. Hallmark, I will turn it over to you. Thank you very much in advance.
All right, thank you. So we're going to talk about the assumptions for the OPEB actuarial evaluation as of 2020. And I have with me Mike Shunning, who is our health actuary, who's going to do a good portion of this presentation. We're going to touch on some background to help shift from OPEB to, or from pension to OPEB, and then go through the assumptions, and then we need you to adopt the assumptions today so that we can come back next month with the OPEB valuation. The OPEB plan is mostly closed. There's a VIBA available for tier 2 employees and tier 1 employees who elected it. So it's only the certain tier 1 members who get the full OPEB benefits. However, there is a catastrophic disability benefit that applies to others. But it is mostly, most of the liability is on a closed basis. Member contributions are just fixed at 7.5% of pay. So what we do in terms of assumptions has no impact on member contributions. The city contributions are set by the board. We have a policy on how to do that. The city has an option to cap their contributions at 14% of pay. So far, our contributions are well below that, so that cap has not come into play. So this valuation, like for the pension, is for contributions for the 2022 fiscal year. When we do an OPEB valuation, there's two different kinds of benefits coming out of it. There's the explicit subsidy, which is what we are pre-funding and what this board really focuses on. And that benefit is that the plan pays the premium for health coverage selected by the retiree up to 100% of the premium for the lowest cost plan offered to active employees. And so that premium subsidy is what we call the explicit subsidy. There's also an implicit subsidy that we calculate and have to disclose and goes in the financial reporting, but it's funded on a pay-as-you-go basis. And that implicit subsidy is the difference between the cost of providing the healthcare, or the expected cost of providing the healthcare to the retirees in the plan, and what the premiums are. So for pre-Medicare retirees in particular, the same premium is used for active employees and those retirees. And we know that healthcare costs depend on age. And so that premium is higher than it would otherwise be because we're covering these retirees. And so that difference is the implicit subsidy. It's paid by the city as a part of their premiums for active employees. And so we have to calculate that and disclose that for your financial reporting. These charts are similar to what we just showed for the pension. but showing last year's valuation results. So the purple bars are the members' contribution. That's that 7.5% of pay. The gold bars are the city's contributions, is about 21 million towards the explicit subsidy. And then they paid another 5 million for the implicit subsidy. So one thing to just keep in perspective here, the city's contribution is 21 million compared to, for the pension plan, it's 206 million. So we're talking about a much smaller program here and liability than the pension plan. In terms of funded status, last year we were about 47% funded, not quite as high as the pension plan, but since this plan just started pre-funding at a much more recent date, it's made significant progress. Again, the blue bar here is the liability for those people receiving benefits. Gold is for those entitled to future benefits, but no longer working for the city. And the red is for the active members. And that active group is going to decline because this is that closed population. The contribution policy we set is that the city would pay the normal costs plus the administrative expenses plus the UAL amortization minus whatever the member contributions are, which is the 7.5% of the closed payroll. We amortize the unfunded over 20 years with a 3-year phase in and out. So instead of using asset smoothing, we just built it into the amortization method. So instead of starting at a full amortization payment, the first year you pay a third, second year 2/3, and then you pay the full amount. On the pension plan, we had those amortization payments increasing at 2.75% each year, but on this plan, we have it as a level dollar amount. So it's much more like your mortgage. Here are the projections from the last valuation. The dark gray is the liability for the explicit subsidy. The light gray is the implicit subsidy. The funded ratio at the top is showing the explicit subsidy funded ratio. So it's ignoring the implicit. And on that basis, we're 54% funded. And the green is the projection of the assets, and we'd be projected to reach 100% funding in 2038. The bottom chart shows the contributions. Member contributions are the dark purple. The gold is the city, which stays fairly constant between 19 and 22 million. And then the dark blue is the implicit subsidy. This gray area in the background are the actual benefit payments coming out of the plan so that you can see the contributions compared to the benefit payments. So that's where we were in the last valuation. We need to set the assumptions for this valuation, and then we'll come back with results next month. We use the same assumptions as the pension plan for most things like mortality, retirement rates, turnover, those sorts of things. But there are some unique assumptions that we need to review for the OPEB plan. The discount rate is unique because the 115 trust uses a different asset allocation than the pension trust, so the expected return's different. And then the others are specific to healthcare. So the first big decision is going to be on the discount rate. With the different asset allocation, we looked at expected returns from Makita over 10 and 20 years, and then an average of several other investment consultants over 20 years. And the expected returns are lower for the healthcare trust than they are for the pension trust. And so the current assumption of 6.75% is higher than the expected returns. And so we're going to recommend that you reduce it.
Bill, this is Trustee Jennings. I read that and I was confused, just because I don't understand why the discount rate would be different on this versus the pension. So maybe you can help me understand that.
So we set the discount rate by looking at the expected return on the assets of the trust. And the healthcare assets are in a different trust than the pension trust. And they have a different asset allocation. And so the healthcare assets have a different expected return than the pension plan.
So they're earning less.
They're earning less.
Interesting.
And I think I'd let Prabhu, or if Laura's on, comment on this, but they are, the asset allocation is simpler and focused more on public markets.
Sorry, Bill, you're asking me a question?
Are they more passive? Is that it?
Did you want to comment on the differences in the asset allocation between the healthcare trust and the pension
So
trust?
the healthcare does not take into account private assets. So we do not invest in private assets for healthcare. So they're all public assets. They're not all passive. There are some active managers in there, but they all tend to be active managers in public equity space. So healthcare does not have any exposure to private equity and so on, which, as we've seen from, the earlier session this morning, they can be very illiquid and take many years to provide liquidity.
This is Trustee Horowitz. Refresh my memory. I don't recall, have we voted on asset allocations for the healthcare trust?
When you say have we voted, Trustee Horowitz, I'm assuming you mean after you've joined the board?
That is correct.
Yeah, no. So that will be coming up early next year, next calendar year. Once again, we'll bring healthcare along with the pensions asset allocation to the boards. But the one that has been implemented was a board approved asset allocation.
So we vote on that and we change the allocation less frequently than the main pension plan. Is that correct?
That is correct. Typically, yes.
Thank you.
Yeah, it has a lot fewer assets. Yeah, the management of it has been different because of the newness and the size and the projections of the liabilities. So we have typically stayed between the 10 and 20-year expectations, which would be somewhere between 5.25% and 6.25%. We don't think it's reasonable to stay at 6.75 given these expectations now. We normally don't want to move the discount rate a lot all at once. But we think you should consider 6.25, 6, or 5.75. 5.75 would put you down in the middle of the range. 6.25 is kind of at the top of the range, but it's still a 50 basis point reduction from what we've done in the past.
Bill, do you have it somewhere on the next slide perhaps, but what is the dollar impact of the 50 basis point drop and then the other 25 basis point options?
So let me We didn't have it in the presentation, but we put together a quick estimate here. Let me show it to you. So this is showing the projection from the 2019 valuation of the contributions and the funded status that we just saw on the chart. And so just, we don't have the 2020 data and everything set up yet. So looking at the impact, if we had applied it in the 2019 valuation, if we drop to 6.25%, note that the 2021 contribution rate was 21 million, and it would bump it up to 22, and then other contribution rates a little higher. If we dropped it to 6, goes up a little bit more, and 5.75. So recall, these were all around 22 million. And so it's ultimately bumping those up to 28. So it's a $6 million, roughly $6 to $7 million a year difference.
And based on our current investment strategy for this particular portfolio, the benchmark data would suggest any one of those 3 options that you suggested earlier, or is it just somewhere in that range?
Yeah. So let me go back to the. So the 10-year Makita was about 5.25, and the 20-year was about 6.25. And so we would really like to get it in that range. And so we were looking at the upper end of that range, recognizing that it would be a significant change if you went further down. That's not to say you can't go further down, but we normally don't like to just move that around too much in one year, and particularly when you're revisiting the asset allocation next year.
So maybe 6.2% would be reasonable, or are you thinking more like 5 in the middle?
6.25 or 6.0.
Yeah.
Yeah. So we were suggesting that you consider these 3. You don't, we didn't go in 25 basis points for the pension plan. You don't have to do that here either. So, you could do 6.1 or 6.2 or something like that. But we wanted to get it sort of 6.25 was kind of the top end of the range we thought was appropriate.
So if you go back to your workbook that you had, and if we.
This or the projections?
Okay, so, but it doesn't have dollars, Brian?
No, the dollars were on the other chart.
Yeah.
So if you went all the way to 5.75, it was
2 million.
Yeah, 6 to ultimately 7 million a year, but we phase that in. So the first year it's something like 2 million.
2 million?
Yeah.
Down to 5.75, Trustee Jennings.
But if we went to 6.2.
It would be, yeah.
It was more like.
It was about 1. Yeah.
It was about what, Jay?
1 million.
1 million.
And that's before taking into account other changes and the experience. And Mike's going to get into talking about what's happened with healthcare costs and those sorts of things. So you don't need to make a decision on this slide. I'd suggest just now that you have this data in background, let's go through the health side of it so you have a sense of how those things are changing. And then at the end, we'll come back to this discussion and make a decision.
Okay.
So with that, I'm going to turn it to Mike.
Okay, and so now I'm going to go over all of the really the healthcare related assumptions. And the first one, and this is more just to present it to you because it's not really a decision, is what's happening to the explicit subsidy. So it's what's happening to the lowest cost health plan, which is what the premium reimbursement to the retiree is based on. And that's the Kaiser $3,000 deductible plan. And actually it only is going up by 6.3%. And that's actually less than what we assumed in the last valuation, which was that they would go up by 8%. So all else being equal, we actually see a reduction in the liability because this didn't go up as much as possible. And then we'll see an additional advantage because of what happened to the Medicare plans. So there are 3 plans that are offered to the Medicare eligible retirees. Historically, only the Kaiser plan has been less than the lowest cost health plan, so the Kaiser plan. The 2 other plans were higher. This year, all 3 of them are lower. So basically, you're going to actually contribute less than what those amounts are. And that's because those premiums actually went down between 5 and 9%. So again, taken together, we'll see a reasonable reduction in the liability just due to the fact that that number didn't go up by as much as we thought it would. So the next slide is it's actually setting the future healthcare trends. So what we think costs are going to go up in the future. And one of the things we look at just to kind of level set is what's been going on in the general marketplace. And so we look at 2 things. One, to get an idea of what's happening to those active premiums, and which are essentially the non-Medicare eligible premiums. We look at the results that come from the Kaiser Family Foundation survey. That foundation does an annual survey of the employer marketplace. So it's been really consistent over time because it's the same employers. And this kind of shows over the last 20 years what's happened is that, again, the early part of this century, costs were going up fairly heavily every year, and it's come down over time. And you can see over the last few years, with the exception of 2011, which is really some implications of the full implementation of the Affordable Care Act. They've been averaging about 6.2% overall. And then the gold bars show what Medicare costs on a per capita basis have been going up, and they've been averaging about 4% over the years. So again, trends have actually, over the last particularly 10 years, have moderated quite a bit on the medical side, which is good for all of us. So the next slide, as we talk about the healthcare trends, because again, we have to predict what healthcare costs are going to be until the last active employee retires and actually is then no longer with us, which is upwards of 70, 80 years from now. And so what we use is something called the Getson model, which is a trend economic model developed by the Society of Actuaries. And what we do with it is the initial trends really reflect what we believe is going on in the marketplace. So it takes into account both those numbers on the last graph, plus what we've seen the city's actual costs going up the last few years. And so the initial trends are starting at about 7.66% for the non-Medicare eligible population and just over 4% for the Medicare eligibles. Then this adjusts down to a longer term rate of 4.93% in 2029, which is really looking at you thinking long-term healthcare costs are going to go up by nominal GDP growth. So it basically keeps up with inflation and the productivity in the economy. Plus, over a shorter period of time, the fact that we've seen historically medical costs go up faster than other costs as new technology comes online. As we're getting older, we use more costs. That kind of plays itself in. But there is what's called a resistance point that it can't stay above long-term GDP growth forever. There has to reach a point in time where, you know, the economy's hitting some fixed level, and we're getting really near that now. It's kind of interesting that if you had this discussion 10 years ago, it didn't look like it was going to slow down anytime soon. But over the last 3 or 4 years, it's actually been fairly consistent at about 18% of GDP. So we're thinking that the longer term is that once it hits about 20% of GDP, we're hitting the level of where medical costs will go up by the nominal GDP growth. And that's so kind of our longer term trend is at 3.78%, which is a little bit lower than what it was last year. And then we keep the dental trend flat at 3.5%. And it's been that for years, and dental has been a fairly stable cost, and it's also a really minor part of the overall liability. So if we go to the next slide, this really compares last year's trend assumptions to what we're proposing for this year. And as you can see, for the non-Medicare eligible, it's a little bit higher in the near term, and it's a little bit lower in the long term, but it's essentially unchanged. And it's a similar pattern for the Medicare eligible. It's a little bit lower in the near term, goes up a tiny little bit, and then kind of stays a little bit below, reflecting that the Medicare costs have actually kind of been a little bit lower than expected over the longer term. They've done a much better job of putting some changes through the control the actual cost increases of the plan. So it's kind of helping keep that fairly moderate. Okay, the next slide is the next thing we look at is we have to make assumptions for what people are going to select. And for existing retirees, we know what coverage they've selected, whether they're covering themselves or family members. But we have to make an assumption to what the future active employees will do once they retire. And we base those assumptions on how retirees actually elect coverage. So we're assuming that the current active members, when they retire, will elect their tiers based on the same way that current retirees are done. So the pie charts at the top show the differences between male retirees and female retirees. And it really shows that for male retirees, about a third of them, 30%, just cover themselves. Another 37% cover just a spouse. Another 28% cover themselves, a spouse, and also dependent children. And a very small percentage are just covering themselves and children. And then for female retirees, it's a very different picture. Over half actually are just covering themselves. And another 24% are covering themselves and a spouse. And then the other two are split between whether they cover just their children or a full family. And so we're proposing some changes in this, and it mainly impacts, as you can see in the bottom, if we go from left to right, the first column is what the current assumptions are. The next is what we're proposing to do for the pre-Medicare. And you can see this for the female retirees, we're proposing leaving those alone because those are trending pretty close to what our projections are. But we're proposing some changes for the males, and what we're seeing over time is less people are covering family members, and they're moving towards just single coverage. Could be an issue of cost, could be an issue they could have other coverage elsewhere, but we've seen that changing, so we're proposing we change that a little bit. But we're also saying we're going to leave the Medicare ones alone, where people are enrolling in Medicare has been really consistent over time, and there's no real need to change those. The next one is, again, it's a similar assumption that we have to make assumptions for what plan we think actors will enroll in when they retire, and we do something very similar. This year is a little different because when we actually set the assumptions last year, the old plans were, they either had a Blue Shield option or a Sutter plan option, and they were city was actually transitioning to Anthem as the non-Kaiser provider starting in 2020. And so we had no enrollment assumption. We didn't really know where the retirees would actually select. And so you can see that they actually selected very different from what we thought for the Anthem plans. And so what this column really shows is the first shows what the actual 2020 enrollment was. So 10% of the retirees took the Kaiser deductible plan, 67% took the Kaiser copay plan, another 8% took the low cost plan. And then you compare it to the valuation assumptions. And what was really interesting is that for the pre-Medicare, the Kaiser, and for the first two Anthem plans, which are their HMO plans, they were pretty consistent with what we expected them to be. What wasn't was where they actually enrolled for the PPO plan. And that we assumed that most of them would go into the lesser cost plans because the Anthem Classic PPO is pretty expensive. In fact, they all decided they wanted to be in the more expensive plan. And the reason I suspect that's true is because that's the plan that actually includes the Sutter providers. And so they were willing to pay more money to actually keep those providers. And so we're proposing to basically make changes on the pre-Medicare side to be more consistent with how they actually enrolled. The same thing happened for the Medicare eligible. And this one was actually kind of surprising that, you know, about 8% of the population before wasn't an HMO. So we assumed they would stay in that HMO plan for the non-Kaiser. In fact, they almost all left and they joined the actual Anthem Medicare PPO plan rather than stay in the HMO plan. So we're proposing, again, changing the assumptions to be consistent with that. And then the dental plan, as we've been seeing over time, a shift out of the dental HMO into the PPO. So we're kind of furthering along that shift that more and more people are taking that PPO plan rather than the HMO.
I have a brief question. And I could be off and wrong on this, so I apologize. If someone's career has entirely been at the city, do they qualify for Medicare? If they've never paid into Social Security, let's say over 5 years or something, I thought they just don't even qualify. And if that's the case, is that an assumption you have?
No, actually, there was a change in federal law. God, it's been 20 some odd years ago, where everybody had to pay into the Medicare part of Social Security. So that there's almost nobody left who wouldn't qualify for Medicare if they've been with the city all this time, because they've actually been contributing to the Medicare side of Social Security for years now.
Really? So regardless, okay, so
Yeah.
people qualify for Medicare and that
Correct.
is not an obligation.
Correct. Yeah,
Interesting.
they just don't qualify for the Social Security piece of it, but they're contributing that 1 point, whatever the heck percent it is, towards Medicare piece of Social Security.
Okay, thank you.
The next ones are kind of assumptions that go on. Again, the Measure F added an in lieu option, which would allow a retiree at time of retirement to say, you know what, I have coverage elsewhere. I don't need this coverage immediately. And so they can actually waive coverage and they get a credit built up of 25% of the explicit subsidy for the tier of coverage for which they qualify. So for instance, if they actually qualified to cover their entire family, the in lieu credit would be based on the employee plus family contribution. And that gets to accumulate over time. When they actually come back to the city and say, okay, now I want my coverage, they've got this additional money that they can use to offset the cost if the premium plan they pick is actually more expensive than what that low cost plan is. This plan, again, hasn't been in place very long, and so the experience is really limited. Again, last year we had 2 years of experience to base assumptions on, and so now we have 3, and so we've been reassessing it every year to say, you know, are our assumptions good? Do we need to make changes to them? So the first is, okay, what's the probability that someone at retirement is actually going to take this in lieu coverage? And so what these charts show, the first one is an active employee who goes right to retirement. And what the square is what the actual observed rate is. So it's saying that, as an example, and for the individuals who retired in the last valuation period, so between 7/1/2019 through 6/30/2020, about 20% of them actually elected the in lieu coverage. So they elected not to do it. Then what we built around it was a 90% confidence interval so that we got a range of what the possible results would be. So really saying we're 90% confident that the actual number, when it's all said and done, we've got 20 years of experience, will be somewhere between 15% and 29%. And so what we show is what the actual results were for 18, 19, and 20, and then what the average is over that 3-year period. The blue line below is what our current assumption is, which is 15%. And as you can see, it's been slowly going up over time. And if we look at the average over the 3 years, it's actually closer to 20%. And so we're actually proposing to change that from 15 to 20%. the same thing we have to do for vested terms, which are individuals who are no longer with the city, aren't currently getting this benefit, but have the right to get this benefit at some point in the future once they reach normal retirement age. And again, this one, you can see the confidence intervals are a whole lot wider, and it's because there's a lot less people in this category. And we've actually seen this move the opposite way, as our observed rate has actually been going down over time. It's less and less of these individuals that are actually electing in lieu coverage when they finally come back in to get coverage. And so this one, we had been using a 20% rate because it kind of started out high, but now the 3-year average is right at 30%. So again, we're proposing to reduce that from the 40% to 30% to be more indicative of what's happening over time. The next assumption relating with this, we're really not proposing any changes because we have very little data, is when they actually come back to the plan, where are they going to enroll? And so we're just assuming now that they're going to elect the same way that all of the current future retirees are going to elect. We don't see any reason to think they're going to be any different at this point until we have some numbers. So this really shows what the actual enrollment was for the retirees currently, and then what we're using for the evaluation assumptions, which really are unchanged. And then the last assumption we have, which again, we only have a couple of years, we haven't had people come back yet, is how long are they going to stay in the in lieu status before they actually come back to the plan and start using the benefit. And so again, we have no data yet to really to know what that's going to be. So we're still continuing to assume if somebody who retired in 2020 elected the in lieu status, the valuation is assuming they're going to stay in that status for 5 years, and then they're going to come back into the plan. And so again, we propose leaving that unchanged until we actually have some real data to see how long they're staying out in the in lieu coverage, because there really is, nobody's coming back. So we really don't know how long people are going to be out before they come back.
Can I ask another question? Because this confused me and you might have explained it earlier. So if you did, I apologize again. In lieu coverage, so I remember there was a point in time where people could choose to not have their health care coverage, right? That was one thing. And I thought it was more Unit 99, but I could be wrong. And so people opted out. But I don't understand in lieu coverage and then they can come back. I didn't know there was like you get to come back. So can you help me with that piece? I'm missing.
Yes, that's part of what was put in place with Measure F, and it's longer term. It actually saves the city and the trust money, because now you're really saying, instead of somebody just, fine, I'm going to take the coverage now, and take the minimum level coverage, even though I might not use it, it might still be covered under my spouse's plan because I don't want to lose the chance to come back in the future. Mm-hmm. No, go ahead and go out, and we'll give you, basically incent you to go away for a period of time by giving you 25% of what we would have paid. So basically the fund is 75%. And then we'll let you come back at some point when you really want to come back and get the coverage.
So they can come back?
So they can come back, yes.
Really?
Yeah, so Julie, let me interrupt there. Michael, you're correct. In the past, when members retire, Barbara, if I misspeak here, please correct me, they have to choose whether to take the benefit or not. And if they chose not to, then that was it. There was no other choice. And that's, I think, what Michael is saying, that even if they were not going to use it, so they wouldn't lose it, they would just take it, even if they were not using it. But this latest option, they allow them to say, hey, I'm not going to use it now. I'll just take my whatever percentage in lieu credit is. And then when and if I have to use and I come back, then I start using it later. And then I can start using those credits anyway. So did I explain that correctly, Michael?
Huh.
Yes, you did.
Wow. I did not know that was part of it. Wow. Okay, good luck on that one. Yeah.
And then the last piece is the actual administrative expenses. So the trust administrative expenses are actually an explicit assumption that goes into the valuation. And if we didn't do any changes, we just do was kind of take last year's and increase it with wage inflation, the number would actually be $46. But if, as you can see on the chart over here, we actually show over the last 10 years what the actual administrative expense was on a per member basis. And you can see that there was a big increase in 2020. And that's really due to a change in the allocation methodology. And so that $90 number is really more indicative of where it's going to be in the future. But since historically we've used a 10-year average, we're proposing to keep using that 10-year average and slowly bring the increased cost into the number over time. Again, as you can see, it as an overall impact on the total liability, it's an extremely small number. But so we're just assuming, instead of it being 46, the 10-year average is actually 48. And if we increase it to fiscal 2022 using the wage inflation, it actually brings it up to $51 from the 46 it would have been had we not seen this large increase. And then the last piece of it is really this is the piece that's used to develop that implicit subsidy that we talk about. And it's the aggregate claim costs. So what we have to do is basically take the premiums that are being charged, and based on the age and sex breakdown of the membership that's actually covered under the plan, both the actives and the retirees, develop an estimate of what the actual cost is by age. And so we do this for every health plan that's offered. What's shown on this page is the aggregate number. So if you took, what the claim cost curve were for the 3 Kaiser plans and the 6 Blue Shield or Anthem Blue Cross plans, and then allocated them together based on the percentage of enrollment between the plans, you show what the numbers are. And this compares what last year's numbers were to this year's numbers. And you can see they're not pretty consistent with what the overall plan increases are, which is, the average increase of just under 6% for the pre-65, and then the decreases for the post-65 plans. You can see what these assumptions are. These won't be the actual final numbers, because we're actually including both, since they're now using the same rate structure between the police and fire and Federated, we're going to combine them together. It has a really minimal impact. We actually went back and looked at last year's numbers and what they would have been had we done that. And it has like a 0.1% change in the pre-65 and less than 1%. 0.1% for the post-65, 1% for the pre-65. So it has really little impact. It's just kind of a allocation between police and fire and Federated for that implicit subsidy that gets paid through the active premiums anyways. So it won't be a real big impact, but just kind of give you an idea of what's going to happen here is that overall, we also expect the implicit subsidy to decrease as well. So if you take this kind of in an aggregate, before you think about a discount rate change, all of these other things that are going to go on, so all the other healthcare cost assumption changes, would actually, on a projected basis, is going to reduce the liability, because costs didn't go up as much as we thought. The medical trends have come down. Some of the other assumption changes are actually reducing the costs, because as an example, if I have more people taking the in lieu coverage, that's going to reduce the liability. We're increasing the number of individuals that have single coverage versus family coverage. It's reducing the liabilities. So a lot of that will actually help offset some of the impact of the change in the discount rate.
I'm sorry, Michael, did you estimate the magnitude of that discount?
No, we haven't estimated. No, we haven't done that yet, because we're still running all that through the models. So that's a much longer process to do. So we don't really know what it's going to be.
Okay.
All ballpark is just given the fact that the low cost plan went up by, so it's going to be at least 2 or 3% just because of what the low cost plan went up versus what the assumptions were, but then the rest of it will have to play out to see.
Okay, thank you. All right, yeah, great presentations for Bill and Michael there. So I'm going to suggest that we try to tackle this in 2 motions, one on the discount rate and another a decision on all of the health assumptions.
And Chair, can I ask excuse me, sorry. This is a trustee Sandra. Can I ask a couple questions? Just
yeah, let me finish this sentence. Yeah, we're not going to call for a motion right away. I do want to, but my version of a summary is that on the discount rate, we're at the 6.75, and Chiron is suggesting that a more reasonable range would be somewhere between 5.75 and 6.25. The 5.75 would be about a $2 million impact in 2021. The 6.25 would be about $1 million impact. And then we have all of the other health assumptions that are to the good. So, and unless there is some inclination to modify any of the health assumptions, details of the health assumptions that Michael described, again, my suggestion is we try and tackle it in two different motions, one on a discount rate and one on all the other ones. But before we do that, Trustee Sun.
Yeah, I have a couple questions. Sorry to interrupt your Michelle.
No problem.
I have a question on page 20. I understand there's a jump on the administrative expense, and then the total impact on the plan probably is not as significant. But just out of my curiosity, what caused the increase, the pretty significant increase from 2019 to 2020? I can't seem to get an explanation on your slide.
Okay, what happened was prior to mid 2019, the administrative expenses are basically allocating the cost of the retirement office across between the pension plan and the health plan. Prior to mid 2019, fiscal 2019, the assets that were, and it's done based on assets. It was done as an allocation between the assets in the pension plan and the assets that were in the 401h plan. It didn't take into account the assets in the 115 trust. And so the percentage of the assets that were then allocated to the pension were a lot higher because that 401h is really small. In 2019, the 401h now has gone to zero, so it's gone. So all of the funding comes from the 115 trust. So therefore now it's based on an allocation of the assets between the 115 trust and the pension trust. And so the amount of assets from a percentage basis that's getting allocated, that percentage is much higher now than it was historically. And so it went from being a fairly small number to a number that's significantly higher. And so that's really what drove the difference. And the methodology going forward is going to be to use that number. So it's going to stay at that higher level.
Okay.
So just last year, the OPEB plan was allocated somewhere between 7 and 8% of all the administrative expenses for pension and OPEB. And this year it's 12 to 13%.
So the 401h asset just completely depleted sometime between 2019 and 2020. That's why this is how this is impacted to the 115 plan.
Yeah. So yeah, the assets in the 401h depleted, and our understanding is that some of the administrative expenses were just being allocated based on the pension and the 401h assets. And so when the 401h assets went to zero, instead of using that, they brought in the 115 assets. And so that's what drove the much larger allocation to the OPEB plan.
Okay, let me follow up on that. Just to clarify. So when did the 401h asset got depleted? In what year?
It was, I believe it was 4 months into fiscal year end 2020.
Okay, no, that makes sense. great. Thank you. And my second question is really for the administration. I'm kind of just wondering, is the retiree healthcare OPEB plan completely self-funded by the city? Does the city buy any kind of insurance policy? Is there any stop loss protection for the city for the plan?
The city's plans are all fully insured. So basically, the risk is all on the insurance companies. They just pay them a premium, and whether the insurance company makes money or loses money is the insurance company's issue. So the city's costs are basically just what the premiums are.
So then why do we have the implicit cost? That's the part I don't quite get.
Well, the implicit cost is basically, again, it's an accounting issue we have to do because the premiums for the actives and the pre-Medicare retirees are the same. They're all bundled together when they set the costs. But the accounting standards and the actuarial standards say, we do know that, you know, somebody that's 60 generates more in healthcare costs than somebody that's 20 on average. And so if in fact the city, and you can actually see this now because the information works, because again, if I look at the people that participate in the VIBA now, their rates are actually developed by themselves and they're strictly retiree only rates. And you can see that they're much more expensive. So if the city went out and said for the current plan, okay, you know, Kaiser split the rate between what would you charge me if for just the actives and what would you charge me for the pre-Medicare retirees, you would see the rates would go down for the actives and they would go up for the pre-Medicare retirees. And so what implicit subsidy measures is really, if you think of it simply as, here's what the rate, you know, if overall the rate's $100 now, if we split them and the retiree rate would now be $120, it's that $20 difference that we have to basically estimate and recognize in the financial statements. And that's why we do it as a recognition in the financial statement, but we're not trying to fund it through the plan because the city pays it every single year based on the premiums that it's paying. So the actives are basically paying that additional $20 in their premiums because their premiums are higher than they would be if the retiree coverage didn't exist.
All right, great, thank you.
Other questions? All right, so, well, let's take a shot and see if it works. I tried to bundle too many things last time on the pension actuary, and we ended up taking those 4 separately. So, but let's see if we can do that with 2 actions here. So why don't we take the health care assumptions first? Is there a motion and a second to adopt the healthcare assumptions as described and identified by Michael in the number of slides that we saw just now?
Jay, you're talking about the healthcare assumptions, not the discount rate.
Correct. All of the things that are listed here except for the discount rate.
Okay, I'll make a motion to accept the recommendation except for the discount rate.
Okay, thank you, Trustee Jennings.
Yeah, Trustee Chandra, I'll second.
Okay, Vice Chair Chandra seconds that motion. Any discussion by the board? Any more discussion by the public? All right, let's do the roll call vote. Vice Chair Chandra.
I vote aye.
Thank you. Trustee Horowitz.
I vote to accept.
Thank you very much. Trustee Jennings.
Aye.
All right, thank you. Trustee Orr.
Aye.
Thank you. Trustee Sun.
Aye.
Thank you. I also vote aye, so that motion carries unanimously. Thank you, everybody, for that. And then let's go back then now to the discount rate. Again, the actuary, Chiron as actuary, says something between the 5.75 and 6.25 would be considered reasonable. 6.25 certainly is a less of a shock impact to the tune of about $1 million, something a little bit more for 6. 5.75 would be somewhere around the $2 million. Does anyone have a motion for the
Can we-
assumed discount
okay.
rate?
Can we just know if we went to 6, what would that cost the city?
So we don't have the precise numbers yet.
How can be
In
roundabout?
particular, because we don't know the reductions due to the healthcare changes
Mm.
that are going to offset it.
Mhm.
But it was in the first year, just based on the 2019 numbers, it was in the range of 1 to 2 million.
And we are going to relook at the investment allocations in the future, like in June or something, I heard,
We will be taking a look at it early next year.
early next year. Okay, so I guess, I don't know. I mean, my motion would be to drop it to 6. That's me. All right.
Okay, thank you for the motion, Trustee Jennings.
I would second that. That seems like a split the difference compromise.
Okay, thank you, Trustee Horowitz. Any,
Excuse me, Chair,
yes.
sorry.
Yes,
When is the appropriate time to make a counter motion?
you can do that now.
Okay, I would motion to lower the discount rate to 6.25%. I would like to give out the reason for the board. I know it's more realistic to, the market condition really believe the rate should be lower, but we also need to look at the entire pension plan together. We can't really just focus on how much this OPEB is going to impact the city by itself. We have just seen the valuation report from Chiron for the pension plan in Federated. The rate, with all the assumption changes and all the valuation, the city's contribution for the pension plan is going to be increased by $16 million. Now we don't really know, since we don't have the dollar amount for the OPEB yet. I would really hope we can minimize impact on a reasonable basis to the city with the OPEB plan. And now, right now we don't know the number, so that I would go for the higher rate for the time being. Of course, we can really look at this discount rate next year again, and to see if we can lower it even further from 6.25. But for this upcoming fiscal year, I would hope we could just go to 6.25. And we are in a very difficult time, even though the equity market has gone haywire for the last 9 months also. We don't know how it's going to how it's going to change next year. And then, overall, the city's revenue really gets impacted a lot by the general economy, and then nobody knows how it's going to shape up in 2021. I would really think we should think about the changes in a little bit more conservative manner. Thank you.
Okay, thank you. So we have another motion for 6.25. Does that motion have a second?
Yeah, this is Trustee Chandra. I would second 6.25.
Okay, we have a motion and a second for 6.0 and 6.25. Let's, any
Mr.
other discussion?
Chairman,
Yes,
just a point of order, you'll take up the substitute motion first.
okay, thank you. Thank you very much. Okay, so let's do a roll call vote then on the second motion at 6.25. Trustee Chandra.
I vote aye.
Thank you. Trustee Horowitz.
I vote aye.
Thank you. Trustee Jennings.
Mm. I vote no.
Okay, thank you. Trustee Orr.
Aye.
Thank you. Trustee Sun.
I vote aye.
Thank you. I'm also voting aye on the 6.25. So that motion carries 5-1 with Trustee Jennings voting no. And Council, do I need to do anything with the other motion at this point? Or that one just dies? by
No,
default?
that motion has been superseded by the substitute motion that passed.
Okay. All right, so that's item 5C, the discussion action on OPEB methods assumptions by Chiron. Bill and Stephen, thank you very much. Do you need anything else from the board at this point on this? Otherwise, you're going to bring it back, final report next month.
That's right. Thank you very much.
Yep, thank you very much.
And happy holidays and happy new year.
Yes, yeah, to both of you too.
Thank
Happy
you.
holidays, happy new year. Great. All right, we're going to circle back to item 5A and 5B. Mr. Pena, 5A, oral update from the CEO of Retirement Services.
Yes, thank you, Mr. Chair. If you bear with me just a couple of minutes, annual health open enrollment ended last November 30th for both plans, Police and Fire and Federated. It was really a success. We had about approximately 400 open enrollment forms. Most of those forms were actually what we just discussed here, the re-enrollment on health in lieu. But we did have other kind of forms enrollment, either people changing between plans or people actually enrolling on new plans. All in all, it was a very busy. Obviously, as you know, there were the virtual options and meetings by the providers, and so I think they were mostly attended by members towards the end of the month of November. But all in all, great job by staff. So thank you, staff, for a great work. They were very hard making sure that they got back to the members, and we're still working through some details. But all in all, it was a success. So thank you to staff for their work. I also wanted to let you know some staffing updates. You may recall at the last meeting, I mentioned that our benefits manager will be out on leave until the month of May. That has some implications to the benefit staff. So what transpired is that we had the two senior auditors positions, one on healthcare that was recently filled internally by a benefit analyst of the pension side. So he is moving as a benefit analyst from the pension side to become the senior benefit on the health. Now that left in a benefit analyst position and a senior benefit analyst position in pension that was, the position was freeze because of the budget. I reached out to the mayor's office and we were able to unfreeze them. So we appreciate the support, given the fact that we won't have a benefit manager as she's out on leave until the month of May. So we are at this point actually initiating the search process for both of these positions. And then lastly, I wanted to let you know that we just welcomed our new senior auditor last November 30th on Monday. We're very excited about his work and his background. So you'll get to meet him in the meetings next year. He's going to have a chance to present to both audit committees in the next couple of months. I also wanted to share with you that I believe, and you can correct me if I'm mistaken, all the new iPads for trustees were received and were distributed to all of you. So if you haven't received your new iPad, let us know. And I believe that you were also then were given boxes to send back you all iPads. And I think that either you have all done so or in the process of doing so. As you know, because of the remote work, we also decided to purchase laptops for the staff. And so we are about a 40 to 50% process where we have provided laptops for staff so they can work from home remotely. So we have about another 40 or 50% left to have everyone at the office with laptops. And of course, what that means is that when we get back to the office eventually, that would be their computer. So it's not as if they're going to have a desktop at the office and a laptop. This laptop is going to be used, the computer in the office. When they're working remotely, obviously they're going to be working on the laptop. And in closing, I wanted to let you know that obviously we continue working diligently and completing all the core duties of the office. So again, thank you to staff for their commitment and their engagement and their work, especially in this very, very challenging 2020 year with the pandemic. We had our holiday virtual party last Friday. It was 3 hours. It was very well attended virtually and a lot of fun. And two last comments. We, the week of the 28th, 29th, and 30th of December, there's a holiday closure, but we're going to have a few staff working different dates. So they will be available as usual by email and phone for members. And lastly, I want to let you know this morning when the meeting started, you approved the PAFR, which is the popular annual financial report, is produced by staff for the 2019-2020. So when you get a chance, take a look at it. It's a very, very good summary of the comprehensive annual financial report. So kudos to staff for a job well done. And with that, again, thank you to everyone for your engagement and your efforts throughout the year. And I know the meeting is not over, but in case we forget, happy holidays to all. So thank you, Mr. Chair, and I'm happy to answer any questions.
Okay, any questions for Mr. Pena?
I just wanted to let Mr. Pena know, I have not received the iPad, so don't know.
That's good.
I'm alone in that. But
Linda is actually obviously attending the meeting, so thank you for letting us know. We'll make sure that you receive your iPad. And by the way, now that you mentioned that, Trustee Horowitz, I failed to let your colleagues know, both yourself, you were reappointed by the City Council early in the month, and so you're back to the Fed Board for another 4 years, and so was your chair, Dave Castellano, was reappointed by the City Council. Thank you, Ms. Davis, at their meeting last Tuesday, and he is also back for another 4 years with the Fed Board. So welcome both of you back, and congratulations. And Trustee Horowitz, we will follow up with staff to make sure that you receive your iPad. Thank you.
Thank you very much, Mr. Pena. All right, and 5B is the oral update from the City Council liaison to the board. Councilmember Davis, thanks for your patience today.
Oh, no problem. Thank you, Chair. So we talked a little bit about it, the pension obligation bonds. The council took action a couple of weeks ago and directed staff to move forward to begin drawing up the legal documents that would be required to actually issue pension obligation bonds. And we will be engaging a consultant and doing all of those things is up to about $500,000 of expenses just to basically decide if we want to do it or not. So it's getting more information. And then we will have a spring study session. I think Roberto alluded to that, to more fully discuss the option, and then also to have staff recommendations come forward about the amount and the timing of issuing those bonds if we decided to go forward to do that. And really, this is all about reducing the unfunded liability, and we acknowledge and understand as a council that what we would be doing is taking the sort of the soft liability of the unfunded liability and making it a hard liability to pay it off. And one of the arguments in favor of doing that is basically enforcing the discipline to ensure that that portion gets paid off in a timely manner. And of course, the idea, as Trustee Jennings alluded to or spoke about, was really to take advantage of the very low interest rates that we are experiencing right now in this country. The other thing that we did that I think is of interest to this board is we received the comprehensive annual financial report and the comprehensive annual debt report. This was just on this Tuesday. In terms of the debt, the airport finance department will be doing some airport bond refunding and refinancing that debt. And that is, of course, to lower the debt service costs, basically to put the airport in a better financial position, since it is having, as I'm sure you have no surprise in hearing, having some difficulties right now due to very, very low air travel. And then in terms of our net position, I just want to mention I just want to read this one paragraph from the management's discussion of our financial report, which by the way got a clean audit as well. I thought you might want to know that. So this is about the net position. Unrestricted net position for governmental activities decreased by $202.6 million or 7.62%, with a deficit balance of $2.86 billion on June 30th, 2020. The primary factor contributing to the deficit in unrestricted net position is the city's net pension and OPEB liabilities. For business type activities, unrestricted net position increased by 0.5 million or 0.18%, with a positive balance of 290.6 million at June 30th, 2020. So I thought you guys might be interested in the net position, which decreased slightly overall for the year. And that's it for my report.
Great, thank you very much. Any follow-up questions or discussion from council members update? Okay, thank you very much.
Happy holidays, everybody.
Happy holidays.
Much longer.
Yeah, bye-bye.
Thank you, Ms. Davis. Thank you.
Okay, we're going to go on next to item 5D, discussion and action on Federated mission statement. And Tom Inichi from Cortex is with us. There you are.
Hello,
welcome, Tom.
Thank you. Good afternoon, everybody.
Good afternoon.
I'll just share the screen if that's okay. Everybody see that?
Yes.
Yes.
Yes, we do.
Good. Again, good afternoon, everybody. You'll recall that the board met in September to discuss the mission statement and strategy of the system. And at that time, we presented a preliminary mission statement for the board's consideration. The board provided some really helpful feedback. We considered that feedback in developing a revised proposed mission statement, which you have before you in this memorandum. The feedback the board provided was really fourfold. It was suggested that we try to incorporate the concept of cost effectiveness into the mission statement. There was some perceived repetition in some of the language, so we've tried to address that. It was suggested that we incorporate the concept of benefits for life into the mission statement, as well as incorporate potentially some sort of tagline. So we believe we were able to address those, and we've developed the following proposed mission statement again for your consideration. Our mission is to govern and manage the system in accordance with applicable fiduciary standards, provide accurate, timely benefits and high quality service to our members and beneficiaries, and collect, invest, and expend system assets in a cost-effective manner. And then we close with a tagline, accurate pension checks on time for life. And so I'll open it up to any further input or discussion or potential action.
Okay, thank you very much. Any reactions to that? So this is, Tom, again, put this together based on prior discussions. This is the, even though we're acting on this one separately, we are, it's the lead into the strategic plan that's going to be next on the agenda. And this, as well as the plan itself, the plan will be for us to look at it every 6 months or so. So for me personally, that's why I'm not as concerned if this isn't, if we were to approve this today and continue to revisit it as the rest of the hierarchy starts to take shape, that is the mission statement versus the strategies versus the initiatives attached to those to make all of this a reality, this ideal scene a reality. So thank you very much, Tom, for doing this. I like it. I think it's a great start, but certainly open to additional feedback, questions from board members.
I'm okay with it, Jay.
Okay. Thank you, Vice Chair Chandra. Other thoughts?
Like tagline. Accurate
Yes.
pension checks on time for life.
Yes. I think that gets to, that hit Roberto's heart is in behind that one. I heard him say that myself. Okay. So if there's no other questions or feedback, we need a motion and second to adopt this mission statement.
Trustee Chandra, I'll make a motion to adopt this mission statement.
Thank you very much, Vice Chair Chandra.
And this is Trustee Sun. I second that.
Thank you very much, Trustee Sutton. Let's do the any discussion from the board, from the public. All right, roll call vote. Vice Chair Chandra.
Aye.
Thank you, Trustee Horowitz.
Aye.
Thank you, Trustee Jennings.
Aye.
Thank you, Trustee Orr.
Aye.
Thank you, Trustee Sutton.
Aye.
Thank you, and I also vote aye. That motion carries 6-0. Next is, thank you again, Tom, for that. And we're going to move on, piggybacking on that 5E, discussion and action on the Federated strategic plan and strategic priorities. I'm sorry, Federated strategy plan and strategic priorities for 21 through 23.
Thank you very much again.
Yes.
As we discussed at the retreat, the board has been really very strategic over the years, but it hasn't had a formal written strategic plan. So this is the first formal document or strategic plan document that the board has seen in quite some time. And again, it was developed with input from board members through telephone calls, surveys, the September session, and it has also included input from senior management, the CEO and the CIO. So this is, again, a preliminary strategic plan, which can certainly evolve over time, and it's expected that it'll evolve over time. I will briefly run through it. We've tried to keep it quite simple and short, I hope. It begins with the introduction and background. The background simply provides a very high-level summary of the legal mandate of the system as it's spelled out in the governing legislation. It then turns to the mission statement, which builds on that legal mandate. You've just approved that mission statement, and you would expect to see it in the strategic plan. It provides a more detailed and hopefully more meaningful description of the mandate for the benefit of stakeholders and plan members. We then move to, the next couple of pages focus on describing the strategy for the system, or in other words, how the organization is going to position itself to effectively carry out the legal mandate and mission statement. And we made the point at the session that you would expect legal mandates and mission statements to be highly similar across systems, but the strategies or how different systems position themselves can vary and do vary somewhat across systems. So in this section, we try to describe how Federated is going to position itself strategically. And we focused on 4 areas: board governance, member services, investments, and human resources. And I won't go through all of this line by line. You'll see on page 3 that we give a very brief description of our strategic positioning in the area of internal board governance and member services. And then on page 4, we describe, again, at a very high level, our strategic positioning in the area of investments and human resources. And we close at the bottom of page 4 by pointing out that over time, the board can certainly refine this description of its strategy or its positioning, and it could expand the description of the strategy by covering other important areas of the organization. And I listed a couple of examples. But this can certainly be fluid and it can expand over time. But we thought these are the 4 areas we discussed at the strategy session. So we thought we would limit it to those 4 areas. But of course, there's perfect flexibility to expand it over time. The next few pages of the strategic plan address how we're going to transition or implement the strategic plan, how we're going to move from our current positioning to our desired strategy. And we've pointed out at the strategy session that you've been transitioning to this strategy that we've just laid out over the years through various very important strategic initiatives. And you've made a lot of progress, but there's still a little more work to be done. And so this section lays out some of that additional work that we need to do over the next several years. And again, it focuses on just three strategic areas, continuing to refine our approach to board governance. And we've identified one strategic initiative in this area, and we've called it Institutional Memory Project, but we can certainly change the wording. This was identified both at the strategic session in September, and it was also identified in the board self-evaluation process for 2020. This project or initiative would involve developing a mechanism or mechanisms to build and maintain the board's institutional knowledge of past board and stakeholder decisions and policies and how they impacted the system. And some examples that were identified at the session were involved the funded status of the plan and the evolution of the investment program, but it could cover all sorts of areas. We thought this project could be tackled in 2021 and would fall under the responsibility of both the CEO and the CIO. The second area where we want to continue transitioning towards our strategy involves member service, or continuing to enhance our approach to member service. And here we have two strategic initiatives. One is we've called the Service Quality Benchmarks Project. This is already in progress, and it involves identifying several member service quality benchmarks, implementing those benchmarks, and designing and developing the reporting tools to inform management and the board on progress towards those benchmarks. That's in progress. It falls under the responsibility of the Chief Executive Officer. It's also tied into the work of the JPC. We think the initial benchmarks and reporting and tools can be developed in 2021, but that'll certainly be refined in 2022. The second project in the area of member services is the Member Communications Program. You have developed a member communication strategy with your communications consultant. That strategy included several high priority initiatives, which we think are sort of short-term in nature, 2021. They include improving and enhancing the member website and expanding the annual health fair to create more opportunities for members to interact with staff. So that's a 2021 project. And the communication strategy also included some longer term initiatives with unspecified dates, but we've sort of assigned those to the 2021-23 timeframe. And I've included as an appendix a detailed review of that strategic communications plan just for your benefit. It's effectively a memorandum that was provided to the board back in May. You can read that for further background. And the third area is to continue to enhance our approach to human resource management. And here we have two more strategic initiatives. Number 4, which is to finalize the design and implementation of the CEO and CIO performance evaluation processes. That's almost done in terms of design. In 2021, we hope to roll that out for the first time, both probably in a mock form and hopefully at the end of the year in official form. The second initiative in this category is to confirm and clarify the system's autonomy on human resource matters. And this stems from Measure G and the evolution of the respective roles of the board and the city in human resource areas. While it's gotten much clearer over time, there's still some practical details to be worked out. So this project is an attempt to better define and document the practical HR issues that require city approval and or engagement by the system. And this would be done by the CEO and the CIO in consultation with the JPC. We put to be determined, but I think that can be a 2021 timeframe. So a short list of projects, 5 in total, broken out into 3 areas, strategic areas. And we closed the plan with a provision for review and reporting. And we've specified that management will update the board at least semi-annually on the progress of the implementation of this plan. And the board would review the plan at least annually. And it doesn't need to be an overly comprehensive review. It's really up to the board, but I think this provides a pretty easy and flexible framework that could be reviewed and updated fairly easily over the years. And that's the draft plan. I'm happy to open it up to questions, comments.
Tom, I'm not sure if it's just me, but on my screen, your screen is on slide 5 still.
Oh, I'm sorry.
Yeah, no problem.
So that is.
Yeah, okay. And then we have the,
here. My apologies.
yeah, no problem.
So
Okay.
that concludes my presentation. Happy to take any questions.
Yes, so thank you again for that, Tom. I think, again, I think it's a great effort, a good start for us to have gotten that mission statement and then talked about the strategies that will, the focus areas, as you said, that are unique to the board that help to get to that same mission that might be different from the statute, but it does speak to what this board and the plan wants to be about, how we want to focus our time and effort. And I do appreciate that you captured at the bottom of page 4 the not just the 4 strategic areas that our board members noted for you, but that you also captured the other 3 that we've not yet had a chance to dig into: the stakeholder relations, risk management, and cost management. And then after that, the initiatives which make it not just a statement about what we want to be, but rather action plans. Who's going to do what in order to make the mission and strategies a reality? So, any other feedback, questions for Tom on this document?
Well, my only comment is thanks for the good work on it. I think it's a good start, and I don't know, maybe annually we should just review it to make sure it still maps to what we believe are the strategic imperatives.
Yes.
Absolutely.
Yeah, and so I like that it's embedded in there, that at the bottom of page 7. Yeah, that management shall report to the board at least semi-annually, and that may be in addition to our annual retreat, the September retreat. It's a kind of codifies that we will take a look at this and refresh it, see how we're doing, and then tweak it on a going forward basis. Other thoughts, reactions to this?
I just want to say that I thought it was a really good job and incorporated everything we had to say. So I wanted to thank you for your efforts in putting all this together.
Thank you very much.
Yes. Roberto, do you have a sense now about when we would next see this? And we talked about this every 6 months, and we know we have the retreat in September. Do you have a sense of how we might be scheduling this prospectively?
Roberto just told me he can't hear right now, so he's gonna call in. Just give him a couple of minutes. Let me tell you the number to call.
Okay, thank you, Barbara.
Here he comes.
Okay.
Hey, Jay, can I just mention as a point of order, I have a hard stop at 2 o'clock. That's when this meeting was scheduled for, and I have an important call with an investor. I don't think that'll affect quorum though, right? Because we'll still have 5.
Yes, that's correct. Yeah, thank you for letting us know. I'm hopeful that we will be done by 2.
Roberto, can you hear us now?
Yes, I can. I just left the meeting. I have to come back in. I could hear now. Thank you.
Okay. So Jay, he can hear now.
Yeah, okay. So Roberto, do you have knowing that we have our retreat in September, do you have a sense of when, over the course of the calendar year, we might schedule the semi-annual check-ins on this? You're on mute now.
Yes, thank you. I apologize. It's been a long meeting, as you can tell. Yeah, it's a good question. I like to think if the, I wonder, well, I wonder if we should use the retreat this year just to, as a kickoff, just to include it there in the retreat, have the discussions of the first discussions of the plan. I don't know. It really depends on, what are the issues the board is going to want to entertain at the retreat. But I think September, it looks like a good month to kick off the discussions for the plan.
Okay. Okay. Yeah. So thinking about the every 6 months thing, maybe we might want to do a check-in before then, and then September, maybe be a more of a major look in the September meeting, something minor, more of a minor work plan update or something like that in the March, April timeframe.
Yeah.
You can give it some thought, but I don't want that to get away from us. I think we want to get this codified as quickly as we can.
Okay.
Okay. All right. So with that, again, thank you, Tom. And on this one, we also need a motion, a second, to adopt the Federated strategy plan and strategic priority for 21-23.
I motion to accept it.
Thank you, Trustee Jennings. Can I have a second?
I second.
Trustee Horowitz, thank you very much. Any other discussion by the board, by the public? Okay, roll call vote. Trustee Vice Chair Chandra?
Aye.
Thank you. Trustee Horowitz?
Aye.
Thank you. Trustee Jennings?
Aye.
Thank you. Trustee Orr?
Aye.
Thank you. Trustee Sun?
Aye.
Thank you. I also vote aye, so that motion carries unanimously, 6-0. Tom, thank you again for that. A great job. Happy holidays to you. Happy New Year. We'll see you sometime early in 2021, I'm sure.
Yes, you're very welcome. Thank you very much, and happy holidays, everybody. All the best for 2021.
Yes.
Stop sharing my screen now.
Okay. All right, then let's go on next to item 5F, discussion and action on the nomination process and election for the position of board chair and vice chair for calendar year 2021. Roberto, would you like to kick this one off?
Sure, and I just want to, as a point of discussion, so first of all, you have before you the board chair and vice chair policies and the selection of the officers. And you should know that based on your board's direction at a prior meeting, these federated procedures are actually part of the governance committee meeting right after this meeting so that they could be updated. I think the concern was that by following the current process, you wouldn't really be having an actual chair until the January meeting. And I think your board felt, just like police and fire, that you want to actually make the election of the officers towards the end of the calendar year, which is December. So what council suggested that your board could do is you can make a motion to override the policy as is written right now, so that you can go through the selection process and select a chair and a vice chair today for calendar year 2021, with the understanding that your governance committee will actually take the board chair and vice chair process and will update them so that in 2021, you can actually make those selections before the end of the calendar year. Once you do make that motion to override the policy, then you can go into item G and nominate and elect a board chair and vice chair for 2021.
Okay. All right, I have a question since I'm new to this and I started in January. Do we do this every year or?
Yes, we do this every year.
Okay. And so, I mean, in prior times, the person who was chair, Matt Lush, I can never say his name. He was chair for quite some time.
Yes, he was chair for about 10 years.
Yeah, so does it just roll over, or do you, each year you re-elect the person, or what?
It is up to your board discretion. It does roll over, but Matt was unanimously elected every year to be the chair. It wasn't a position that a lot of the prior trustees in prior boards were very eager to fulfill. And so Matt remained chair for many, many years. So again, all we have to do is really, again, we will have to override the nomination and election procedures on F, so that then you can go to G, and then you just follow G, except that you follow the process, except that you're making the election in December. You certainly can choose a person, a new chair every year. You can do something different. In fact, your governance committee after this meeting will sit down and go over that process and decide if there, besides the timing issue, if there are any other changes that you would like to make. For example, I can tell you that Police and Fire, it is an annual event, but for the most part, once they select a chair for 1 year, assuming the chair has done a good job and wants to remain chair, they will select him for a second year. And then they also have the further qualification that when you have, say, a member of the plan like yourself, chair of the plan, the vice chair have to be from the public side. So they want to make sure there is a difference between the chair and the vice chair. Not that you have to do that. They do have very specific. The board had some challenges many years ago, and that was the way that they sought to kind of limit the powers within the different board members back then. But in any case, my point here is that you can really make these changes any way you want to. You can select chairs for 1 or 2 years. This is your procedures. You decide how you want to handle this.
Okay, and do we know, does Jay and Trustee Chandra, are they interested in doing this again? Or?
Well, that'll be the next item.
That was the next idea. I would suggest, that if your board is comfortable going through the nomination and election process today, you should make a motion to override the policy as written right now on F, and then that can take you to G.
All right, I make a motion to override and do it now.
Okay, thank you, Trustee Jennings, for the motion. Is there a second to that motion?
Yes, I second.
Trustee Horowitz, thank you very much. Any other discussion by the board, by the public? Okay, let's do a roll call vote. Vice Chair Chandra?
Aye.
Thank you. Trustee Horowitz?
Aye.
Thank you. Trustee Jennings?
Aye.
Thank you. Trustee Orr?
Aye.
Thank you. Trustee Sun?
Aye.
Thank you. I vote aye. That motion carries unanimously. So we will strive now in item 5G to do the nomination selection now so that the new chair, vice chair can be in place for the January meeting.
Michelle, can you call the board chair item in the charter on the screen? So, okay, thank you. Go ahead, Mr. Chair. I apologize.
Oh, yeah, no problem. So we have the board chair charter in the packet and on the screen. The vice chair charter is also part of the packet if there's any questions about duties and responsibilities. Just to get to Trustee Jennings' question, I have enjoyed the time as chair for the year. It's been a very good learning experience for me, And I'm more than happy to step aside if someone would like to take on that role. So
But are you willing to do it again?
yes, if no one else is interested, if that's not of interest to anyone else on the board, I am willing to do that again. But if anyone else does want to, I'm more than happy to share the opportunity. So, and I believe what we would want to do, since we're trying to get this done in this one meeting, we would need to get nominations, and we would need to, for whoever's nominated to accept or deny the nomination today. So that we can take the votes.
Okay. So I nominate Jay to be chairman again.
Okay.
Trustee Chandra, I'll second that.
Okay, thank you. I'll accept the nomination. Are there any other nominations?
You seem to be winning every election lately, Jay.
We're gonna see if he follows along with Matt, you know.
Okay.
Jay, we're hoping you can beat Matt's record of 10 years.
That, yeah, I don't think that'll be possible. All right, let's do the vote, a roll call vote. Vice Chair Chandra?
I vote aye.
Thank you.
Mr. Chair, I just want to make
Yes.
sure, Mr. Chair, I want to make sure that we're clear. The motion, what you're counting right now, they nominated you and you accepted it, right?
Yes.
So now you're asking for a vote for you to become the chair.
Yes.
Okay, just wanted to make sure that is clear to everyone.
Okay. All right, so Vice Chair Chandra, if you wouldn't mind confirming.
I voted aye.
Okay, thank you.
I vote aye.
Trustee Horowitz?
I vote aye.
Okay, thank you very much. Trustee Jennings?
Aye.
Trustee Orr?
Aye.
Thank you. Trustee Sun?
Aye.
Okay, thank you. And council, do I need to vote on this?
Council have to leave the meeting. That's why I spoke on his behalf.
Okay.
But yes, you can vote for yourself, Jay.
Okay,
And
all right.
you will win either way.
Yeah, okay, all right, I'll vote aye, so that carries 6-0. What about the vice chair?
Okay, so another question
Yes.
is Trustee Chandra interested in doing this again?
Yeah, well, let me, thanks for asking. So in the absolute final analysis, if no one else was interested, I'm happy to be renominated, but I think there are a couple of things I should share with the board. Last year I did it. I think there was a sense of many trustees felt they didn't have enough seniority and comfort with board procedures. So I think I was sort of, kind of not the best choice, but maybe the only choice. And I don't think that's the case this time around. A couple other things I should share is I'm on a very precarious edge with my colleagues at my venture firm on how much time San Jose takes of my professional time. And behind the scenes, I do spend a lot of time with Prabhu and his staff since I chair the IC. We also, as a venture firm, have extremely busy Mondays. So I have not really been able to participate meaningfully in the agenda sessions. And this past year, Jay's been great. I mean, he's really handled all of that and been available to chair all the meetings, which has made it much simpler for me. But I do have some pressures that might not make me the most ideal vice chair if if Jay has issues or can't be available at different times throughout the year. So I want to throw that out there in case someone else, is now more comfortable with their board tenure and is interested in being vice chair.
Okay, and then Roberto, I have a question. So you were mentioning how we have a public versus private. I mean, Jay's a retiree, so what if Trustee Chandra was not the vice chair? Who would be? you know.
So Trustee Jennings, I was just giving an example. You don't have that requirement in the Federated Board. I would just give you an example of what Police and Fire does. You don't have to do that. So there's not a requirement for the Fed Board.
Anybody else interested? Rather than just nominating someone. Trustee Orr, how about you?
It's kind of you to pose the question. I'm not able to take on any additional commitments at this time.
Trustee Horowitz?
I'm unsure of the time commitment that the vice chair would require. I imagine it's not as onerous as the chairmanship. Can you speak to that, Mr. Pena?
Yes. I actually don't believe is really much more, Trustee Horowitz. I think, so I spend more time with the chair, not only on the agenda, but on other issues. The only other item that I can think of that the vice chair usually attend is the week before the meeting, we have an agenda review meeting for the agenda, where it's always helpful to have both the chair and the vice chair available. But I think other than that, and other than, just staying in touch with the chair, I don't want to speak for Jay, but I don't think it's much more time consuming. I don't know, Jay, if you have any other. It does get accompanied with a 10% increase in pay. I was kidding about that, but
Vice Chair Chandra could best speak to it. I mean, I know we're all busy, and I will always do my part to minimize impact on others. Vice Chair Chandra can probably best answer Trustee Horowitz's question.
Yeah, sure. I mean, unfortunately, I think I've ended up making the vice chairmanship about as time efficient as possible, because I have really struggled to attend the Monday meetings the week prior to the actual board meetings. I think that would be the most significant time commitment on a consistent basis, and it's a 30-minute meeting, but it conflicts with my duties at my firm. The only other thing would be if Jay were unavailable for a meeting to chair, you just might need. You may have to prepare a little bit better for that meeting than just reading the stuff. You may want to spend some time with Roberto and with Harvey, other members of the staff, just to understand issues, procedures. That would be it. And quite frankly, that is my biggest concern for myself as vice chair, is if there happens to coincide with a meeting that Jay can't attend, and I just can't put those cycles in before the meeting because of my professional commitments, it would lead to a suboptimal meeting. But that didn't happen this past year. Jay was in charge of everything and did it really well.
Well, Trustee Chandra, I think your point is well taken. You're absolutely right. That's why your board elects someone like Jay, who is retired and have the time and is available for every board meeting. So, Trustee Horowitz.
Okay.
Jay hasn't missed a meeting yet, except for one, but when he did, he wasn't a chair.
I nominate Trustee Horowitz to be vice chair.
Thank you. Is there a second for that?
I'm sure. I'm happy to second that.
Okay. And Trustee Horowitz, do you accept that nomination?
Well, as I am retired, I think I can put the time forward to do it. Although I am relying greatly on your health and stamina, Chairman Jay.
Okay, very good. I told him at the interview that I would be available for all the meetings, so hopefully I keep that, and just a little pressure on you.
I've said a lot of things in interviews, but.
Okay, Vice Chair Chandra?
I vote aye.
Okay, thank you. Trustee Horowitz?
Aye.
Thank you. Trustee Jennings?
Aye.
Thank you. Trustee Orr?
Aye.
Thank you. Trustee Sun?
Aye.
Thank you very much. I also vote aye, so that motion to appoint Trustee Horowitz as Vice Chair for 2021. That carries unanimously. Thank you very much.
Congratulations to both of you. Look forward to working with both of you for the next.
Yes.
I hope the fact that you were both just reelected by the council does not mean that your colleagues are hoping you become chair and vice chair for the next 4 years. Who knows?
That would be a massive bait and switch, yes.
All right. So section 6 of the agenda, 6.1 is investment committee. Last meeting was nothing since our November 19th meeting. Next meeting is on December 22nd. Is there an oral update from the chair of the investment committee, Vice Chair Chandra?
Yeah, I'm not sure if Trustee Sun or Trustee Orr provided an update in November for the meeting I missed when I was sick. We are meeting next week, and in October, we essentially went over the private markets plan in a little bit more detail than we did as a board today, but most of it was an overlap. So the board should be, the board's in the same place that the investment committee is.
Okay, very good. Thank you very much. 6.2, governance committee. Last meeting is October 18th. Next meeting is right after this meeting today. Trustee Horowitz, is there an oral update?
Well, there's no update, but with Trustee Keller absent, do we have a quorum for the meeting that's meant to take place immediately after this meeting?
Yes, so as long as 2 of the 3 members are available, Trustee Horowitz, there's a quorum. So it's yourself. Oddly enough, the chair and vice chair of the boards are available for the governance committee. So yes.
Okay.
So we'll have something to report next time then.
Okay, very good. 6.3 is the audit committee. Last meeting was October 15th. Next meeting is February 18th. Trustee Jennings or Trustee Sun, do you have a oral update in lieu of Trustee Kelleher?
Jay, Trustee Kelleher provided the update at the last meeting where the audit financial statements were approved and everything else. I'm sorry, Trustee Sun, I didn't mean to cut you off. I apologize.
Oh, no problem. I was intent to say exactly you just said, because I think you did an update. Yes. That was the CAFR.
Yes.
Okay, very good. 6.4 is JPC. Last meeting was October 10th, and next meeting is TBD. Trustee Orr provided an update at the last board meeting on this November 19th. And Trustee Orr, is there anything else that you'd like to add today?
That's complete. Thank you.
Okay, thank you. All right, item 7, education and training. We have a report from Cortex. We have the Calipers Virtual Assembly in March, and there's a flyer in the packet. Are there any future agenda items that we wanted to identify today? Okay, any public retiree comments?
Mr. Chair, if I may, just a couple of things. First, I just want to take 30 seconds to publicly acknowledge the work by the staff in this challenging year with their work and commitment and engagement. It's been second to none. So on behalf of the boards, on behalf of the members and the stakeholders in general, I want to publicly acknowledge and thank the staff for their hard work and dedication. I also want to take some time, which I don't usually do often, to acknowledge the efforts and the work by each one of you as trustees of this board. Obviously, your only experience is working with your colleagues at this board, and you may have some reference of the work that Police and Fire does as well. But, obviously you have consultants like Mikita and Chiron and your council that have experience working with many boards across the state and the nation. And I can tell you that more than half the job that you do is really your commitment to your work and your position as trustee. And I find the engagement by your board and the commitment second to none, to be honest. That's half the job. I can tell you, for example, I know some friends that are trustee in other boards where they have discussion, asset allocation and other areas, and it takes 15, 20, 30 minutes at the most, and that's it. I don't mean to equate an hour discussion on an item to commitment, but the point being is that you are always, all of you, not only committed, but prepared ask the right questions, and you take your job seriously and you get ready for the work. So I can tell you on behalf of the staff, and more than anything on behalf of the membership and the plan sponsor, I want to thank you for your work, for your efforts, your engagement throughout the year. It's been very challenging, as you know. And so thank each one of you for your work, and wish all of you happy holidays and health to you and your families through the holidays. So thank you very much.
Yes, thank you. Thank you, Mr. Pena, for all the kind words and for acknowledging everybody and everyone's efforts. All right, so as we adjourn, I would like to do the same. Wish everyone a wonderful holiday season and a great 2021. So we are adjourned. Thanks, everyone.